or that coach or that teacher and continue to learn from them, because there's only so much we can cover today, but know that each of them have so much content they could continue sharing with you. All right, so how did Sugo Capital progress? So I started investing in real estate in several things that did not work for me, single family homes. I lost a lot of money, but I kept going and I ended up in the apartment space. And so Sugo Capital started in 2019. I started as a passive investor in real estate. And then in 2019, I became a co-GP, and I'll explain what all that means and about apartment investing during my time slot. But since then, Sugo Capital has grown to 36 apartment complex acquisitions with their investor partners. So passive investors in our Sugo Capital community, we have about 25,000 at this point. And so I really think it's a blessing that I'm in this position to be able to help people grow their money while I also get to grow my assets and my footprint in this world. And so with that, I see that our first speaker is here. So I'm going to say, let's welcome Lee Arnold. Lee, I see you're in here. Cynthia, if he has the ability, please make him co-host so he can share his screen and turn on video. Hi, Lee. Good to
Hi,
have
Sarah.
you.
How are you?
I'm good. I was listening to some music on the way home after dropping my kids at school, and I was like, oh man, it was rock and roll. And I thought, I wonder if Lee's going to have some funny pictures in his presentation. So you guys, the reason I'm saying that is Lee and I went to the Rock and Roll Hall of Fame, oh, it was 4 months ago now, something like
Yeah,
that.
yeah, it was fantastic.
It really was very fun. So Lee Arnold has been in the real estate space for quite a while. You know, he is one of the beacons, icons in this space. So we are really blessed to have you here today, Lee, with all the folks who've signed up and who are logging on still. And what I think is really cool about your company and what you guys do is you don't have like one specific niche. You have kind of this, you have a name for it. Sorry if I can't remember, but it's the wheel or the circle of wealth.
Circle of Wealth, yep.
Yeah, circle of wealth. So you really help people on their entire journey make decisions, because where you are today, you have goals, you have aspirations, and then in 5 years, you're going to have different goals and aspirations. So different material, different investments work for you at different times in life. So I love that you guys help your investors on that full circle. And with that, I don't want to eat into your speaking time. So you guys, Lee Arnold, fabulous, Secured Investment Corp. Thanks for being here, Lee, and I'll let you take it away as our first speaker
Well,
today.
before you go, Sarah, I just want to say thank you for having me and thank you for doing this. You and Cynthia are so awesome. And I loved hanging out with you guys at the Rock and Roll Hall of Fame and at that whole event. It was cool. And I apologize, I didn't put in the cool pictures of you standing in front of the NASCARs.
I thought for sure, or us on the drums or guitar, whatever we were doing.
Yeah, it was really fun, and I really enjoyed just spending time with you. And thanks for putting on this conference. This is fantastic. I'm really excited for the other speakers that you have here as well, because just some great content, and it's going to be a great day. So thank you for doing this.
Oh, it's my pleasure. Thank you.
You bet. And I need to share my screen. So if you can help me do that, Sarah,
Yes, Cynthia,
um,
can you take it away?
or Cynthia. How do I share my screen with you guys? There we go.
Got it.
Um, and it's going to be this
All
one.
right, there you go. Should rock and roll.
You got it? Are you seeing me?
Yep, cash flow is king. Got
Okay,
it.
perfect. All right, cool. All right. Well, good morning, everybody. My name is Lee Arnold. I'm the CEO of Secured Investment Corp, and we are an alternative investment platform. And we do a lot of things, as Sarah mentioned, but really what we try to do is a more holistic approach to investing for all of our clients, because we know that not all investments are created equal and not all investors are looking for or trying to accomplish the same things. So our goal is to identify who our client is, what it is they're trying to accomplish, and then help them accomplish it in the shortest period of time possible, depending on risk tolerance. So you can be a full-time active investor where you're buying and investing and flipping and really manhandling the process and the projects yourself. or you can get involved in more of a passive opportunity where you're either investing in private equity funds or you're buying whole notes. But our goal for our clients, more than anything else, is cash flow. And that's why it's the front slide here, because cash flow really is king. And I've invested in syndications. I have sponsored syndications. We have syndications that we're working on. And I think syndications are a great investment. My only downside or my only challenge sometimes with syndication is my money is in with a lot of other investors in an asset. And so I don't have the freedom as much to come and go as I please, which is fine for some. Like I said, to be diversified into that, highly recommended. But I also want to have money in investments where I have more liquidity more quickly. And that's why we invest in private money notes. So private money notes are debt secured against real property. So it's just like any other asset class where many of them are secured against real estate. But our goal is to put one investor in one note so that they have 100% ownership and control and really the ability to call the shots as to what's going to happen with that alternative asset. So with that as introduction, I want to jump in. And of course, I have to cover my disclaimer because my attorney says so. But everything I'm going to talk about here today is past performance, not indicative of future results. And we are not affiliated or registered as a registered investment advisor or broker dealers. We do not provide investment advice. There are no assurance that any strategy will succeed or that any program will meet its investment objectives. So there's the disclaimer. Let's jump in. So the motto of our company here is we get more of what we want by helping others get more of what they want. And that's been our motto since inception. I started flipping houses back in 1996. So we've been buying, fixing, flipping, selling, lending on real estate for almost 30 years. This is my wife, Jacqueline. We have been privileged to work together in the business for, I think she's been in the business since 2006. So almost 20 years that she's been working with us as well. She's the president over the organization. But we are a lender, we are a real estate investor, we are a private equity fund manager, but we are also an educator. So we have a nationwide education company called the Lee Arnold System of Real Estate Investing, where we teach people how to invest in real estate, the kinds of deals they should be focusing on and looking for to reduce the risk. Because as you heard Sarah mention, there's risk in everything that we do. And if we don't really understand the asset class that we're getting into, oftentimes things occur that we weren't anticipating or didn't think could happen. And then suddenly something goes wrong and there we are. So we want to avoid risk as much as we can. So we've developed a box for our investors and we teach our clients, if you'll just stay in this box, doesn't matter what's going on in the market, the economy, doesn't matter what's going on in the White House, doesn't matter who's in the White House. If you stay in this box, you're going to be relatively safe and insulated from a lot of these market fluctuations that are occurring. And I'm sure you guys already know there's a lot of concern in the markets right now. We know that the Fed's dropped rates 50 bips just yesterday, which is really exciting for the market. I'm excited to see how that's going to play out. I do believe that as a result of this, we're going to see an uptick in real estate residential mortgage sales. I think we're going to see a huge slew of refinances now coming through. I think it's going to unlock a lot of inventory that has been log jammed because so many people refinanced in 2021, 2022, and they have rates at 2.5, 3, 3.5, and they've been hesitant to either sell that asset or to move or to refinance because rates have been so high. With the 50-point reduction yesterday, we're now seeing FHA, VA, USDA, the top 80% of all mortgage loans to first and second time home buyers in the affordable asset space. There's going to be more inventory. We're going to see more loans coming through, more refinances, and I just think it's going to be phenomenal, which is going to be interesting between now and the election. We are expecting another quarter-point reduction in November, and then the prediction is another one in December. So come January, we could be sitting on rates that are 1 point lower than they are now, and the Fed rate just on Monday of this week, we were sitting at 4.99. So if we get another 2-point drops or 25 basis points drops by January, we're going to be sitting at 3.99, which is, as we all know, we haven't seen that for quite some time. So it's going to unlock the markets, and I think there's going to be a lot of opportunity. And a lot of the syndications that have been kind of log jammed and not able to refinance out debt or take advantage of equity from forced appreciation, I believe that's going to be able to be unlocked. So it's a really fun time to be in the market and a great time to be an investor, at least in my opinion. Over here on the right-hand side of your screen, this is what Sarah was referring to. This is what we call our circle of wealth. Beginning with our nonprofit ministry called He's the Solution. We do something here called Business as a Ministry, or BAM. So we like to use our access to clients and customers to share the gospel of Jesus Christ. I'm a born-again Christian, have been for many, many years, but we want to propel that message through our business, so that's why it's at the top of the wheel. But through that, we want to take clients through the Lee Arnold system of real estate investing, teach them how to safely invest. And then through Kogo Capital, we originate mortgage paper for them to buy these assets. So most of our loans are going to be fix and flip. They are 12 and 24 months in length. We do not do any 30-year paper. So very short-term, 12, 24-month loans, interest only, to investors. So we do not lend to owner occupants. We only lend to investors because we eliminate all of the red tape of RESPA and needing a mortgage loan originator's license nationwide. So we lend to investors. So we train them through our education system, and then we lend to them through Kogo Capital. The funding that we have to lend them the money is through one of two of our private equity funds, which is High Yield Fund 2, Secure Investment High Yield Fund 2, and what we call the Circle of Wealth Fund 3, which is a Reg A plus fund, a non-accredited investor, only $1,000 investment to get into that fund. And we did it because less than 5% of the population is accredited, so we wanted a fund that more people could participate in at $1,000. So that's why it was important to us to do that. In retrospect, setting up a Reg A plus in 2019 when it was relatively new, there wasn't a lot of case law to support it. Probably could have thought that through a little bit more thoroughly, but we've been now in that space for 5 years. It's been a blessing to us, to our clients, so we're glad that we did it. But that's secured investment in our funds. So the funds lend money to Kogo Capital, and then we service those loans internally through our servicing arm called Lake City Servicing. So the goal is we take people where they are, regardless of their credit score, how much money they have or don't have. We teach them how to invest in real estate. We give them the money to invest in real estate. And our goal is to help them become an accredited investor so that they can participate in calls like this that you and I are on right now, and participate in the really fun and exciting world of alternative assets where we can get those double-digit rates of return. So our goal is to make every client we touch at some point become an accredited investor so that they can retire, they can have the income that they need for themselves and their family. But more than that, we want them to teach their kids so that they are creating legacy beyond just money. We want them to teach their own friends and family how to do it so that they can pass that and leave that. Now, I'd love to tell you that I've had this all put together, but it's taken a minute to do that. And the thing that really shook me into action and changed my perspective was 2008. So in 2008, we all know what happened in 2008, but I had been investing in real estate since 1996, so 12 years. And, you know, it was the natural progression of an investor. I started buying, fixing, and flipping little single-family homes, and then, you know, started buying multifamilies and getting into development. And by the time 2008 came, I was building $23 million homes in Park City, Utah. There were 14,000 square foot ski and ski up, beautiful homes. And I had 3 of them coming to market in July of 2007. Had a big page spread in Ski Magazine, and, you know, this was going to be my final play. You know, when all these houses sold, I was ready to retire. It was going to be fantastic. But we all know what happened. I was over leveraged. I was spread out too thin. I had leveraged my portfolio of real estate and used it to do private money lending, and everybody stopped paying their creditors, and it was just a big mess. And so what I realized through this is that there is a safer way to do it. And if we understand the rules of the game, and we play by them, the market will reward us very favorably. So I want to start here with risk tolerance and understanding it. As I mentioned, our holding terms are short, okay? So 12 or 24 months is the length of our notes. And we are underwriting to a very conservative criteria, not exceeding 65% of the ARV, so the after repaired value. So we're staying low, and then when we exit, the investor who we lent the money to is fixing the property up and then selling it, or we're assisting them in refinancing it if they want to hold it as a long-term rental. Now, I'm not here today to talk to you about buying, fixing, or flipping single-family homes or residential multi 1 to 4 unit properties. That's not my goal here. Simply to help you understand how we create the opportunities that we then make available to you guys, either in our private equity funds or in buying the notes that we are originating. So we put together this slide as it relates to risk alignment, and we mentioned syndications, which, like I said, I've invested in them, I've sponsored them, I've GP'd them, and I think they're a great asset class. I have gold, I have rental properties. I had crypto, but in all transparency, I had to sell it because I was a nervous wreck. I was constantly checking the markets, and every time Bitcoin would go up, I'd be on this high, and every time it would go down, I'd be like, oh no, what's happening? Personally, I'm not sophisticated enough to understand the crypto space. So like Warren Buffett says, invest in what you know and hold what you understand. And so for me, that is residential single family 1 to 4 units. And so that's where we stick. So the alternative investment that I'm here for is private debt to create cash flow. And as I mentioned, we do this through mortgage notes, which is a legal document that represents the loan made to a homeowner to purchase the property. Then there's a contractual agreement between us and the borrower. But what a lot of people don't understand is that that mortgage note that we're creating is transferable. It can be bought, sold, traded, leveraged, and it's a lot easier and faster to sell a private money mortgage note held against real property than it is to sell the actual real property. And so when we originate the debt against the asset, we then begin servicing it, collecting the monthly payments, but then we make that asset available to our investors to buy it wholly, where they're 100% in. And the nice thing about this is you can buy it through your self-directed IRA, retirement accounts. You can do it through your whole life policies. If you have equity in your whole life, you guys have probably read the book, Being Your Own Banker. And all of those different strategies, but you can do it in the debt against the real estate without actually owning the real estate. Now, Sarah mentioned Rich Dad, Poor Dad, and that was a book to me that was also very influential in my career. But the thing that stuck out to me in Rich Dad, Poor Dad is you've got to stick to the cash flowing investments in those assets. But what I learned through the initial education group that I got training from was this. This was their goal. This was their kind of their outline for their clients. It was to buy one house every year, put a 30-year mortgage on it, and put a tenant in there and let them pay. And then every year buy another one and another one and another one. And by the end of 30 years, you'll own 30 homes. And on year 31, you'll have one paid off free and clear. In year 2, you'll have 2. In year 3, I'm like, that's a 60-year window. That's not going to work for a lot of people. The other thing that I learned through that is that owning rentals, while great, a great investment, it can be challenging. If you don't have systems in place, if you don't have strong property management in place, it can really be challenging. And so I started looking at this and I went, wait a minute, if I just own the debt against the asset, when your toilet breaks down, nobody calls Bank of America or Wells Fargo, whoever did your underlying loan. When the roof blows off, nobody calls the lender, they call the insurance company. If a tenant has a toilet backup, they don't call the bank, they call the owner. And so I said, how can I benefit from real estate and the security of real estate without having to deal with all of the stuff that you get when you own real estate? And that's why we went into the debt side, because now, regardless of what's happening in the market, or regardless of what the feds are doing with rates, the minute we write that note, if we write that note at 8, 9, 10, 11, 12% interest, that's fixed. So nothing is going to change or adjust that interest rate on that note, which means we can rely on pretty stable and consistent cash flow. And that's what we're trying to accomplish. So it's a versatile investment. It serves as the foundation of single-family residential property investments, and it provides lenders and investors with opportunities to earn returns while supporting home ownership. So some of the note strategies. Now, I know you guys are all very sophisticated. Many of you are already investing in this asset class. But there's 3 different types that we encourage, that we represent. One is performing notes. So this is where a borrower is current on all of their payments. If you buy that note, let's say it's a $100,000 note, it's written at 12%. You transfer $100,000, you own the note, you now have the right to receive those payments at 12%, it's $1,000 a month. Great, everything's going well, okay? However, about 3% of mortgage notes secured by real property to investors. It's a little bit lower where it's owner occupied, but 3% typically in the real estate investor space. So if you buy 100 notes, there's a chance that 3% of them are going to go into default. And this is what now becomes a non-performing note. Now, there is a slew of investors out there that like to buy non-performing notes because you can typically get them at a pretty steep discount. So if I put out $100,000 on a note and I collect 2 years of payments, that's 24 grand, which means I'm now sitting in that note at $74,000, and suddenly it goes into default. I could turn around and sell that non-performing loan for 70 or 75,000, get that back out and go do it again without having to take it through foreclosure and deal with all of the pains of foreclosing and an REO asset somewhere across the country. I can just sell that non-performing note. And as I mentioned, you can typically get deep discounts when you do this. Now, I can tell you that a non-performing discounted note would fall under the classification of more of an active investment strategy, because you really are going to have to babysit that thing and manage the attorneys that are handling it. So our recommendation for the majority of our clients for their portfolios is to focus on performing loans that are well underwritten. A mentor of mine told me years ago, he said, Lee, a loan well underwritten is a loan half collected. So in this space, you really got to look at the underwriting. So, and I'm going to give you guys a resource here in just a few moments at the end of my presentation, where I'm going to give you a lot of different vendors that sell mortgage notes so that you can go check them out. But check and make sure you follow the underwriting. It needs to be a good asset in a good location, below 65% LTV or loan to value, so that we can do a risk tolerance adjustment for markets shifting and price values adjusting. But at 65% of the current value, you're in a pretty safe position. The other thing that will help you is a borrower with good credit and a borrower who puts money down. Down payment or contribution directly from the borrower into the loan is going to dramatically reduce risk of foreclosure, and you're usually going to get on-time payments all the time. So there's great paper that's out there, and what we would call A paper. And if you're looking to buy A paper, you can anticipate yields or returns between 6, 7, 8%. B paper, which would be maybe a borrower with maybe a lower credit score, but a lot of history. So they've done a lot of deals, and we have numerous successive ins and outs where they borrowed money from us before, they've sold it, they paid us back, we're doing another loan. So there's a lot of things you can look at to really reduce your risk on these things. So the potential for steady income is there. It's a great diversification play. You escape property management completely because, like I said, you don't actually own the property. You just own the debt against the property. And that debt can be sold and transferred very, very quickly. It can be held in a 401k or other investment-friendly device. And it's always secured in real property, secured against real property. You know, that was my challenge with alternative, with Bitcoin and the cryptocurrency, is I didn't understand it. It's like, what is this secured against? How do I defend or deflect against, market fluctuations? I couldn't. But with real property, I can look in any market wherever that property is located. I can see the trends. I can see, is the population increasing there? Are property values going up? Are they going down? Do we have industry leaving in mass, going away from that market, so that we're going to see a reduction in property values? The nice thing about being secured against real property is I can look at the market as a whole and go, okay, I don't think I want to buy a note in that area. And that's part of our education program, is teaching you guys what to buy, where to buy, and what we believe to be a safe investment for your portfolio. Because ultimately, guys, we want you to have a great experience. We want you to get the yield that you're looking for. We know that everybody's got a certain yield requirement that they need to hit, either for their retirement goals or for their monthly expenditures. Many of our investors are actually living now off of the returns because our Fund 3 pays out monthly. So we're doing interest distributions every month. And our accredited investor fund, which is a 9-pref, that one's paying out quarterly. So we have a lot of our clients now that are just living off of the returns because we're just sending them checks every month. And that's what we love to see, and we'd like to see more people being able to participate in that. So some risks of note investing, as we covered: the borrower might default. It could take them longer to fix the property than expected. But understand that we are monitoring that. We are facilitating the rehab on those properties. We are inspecting all of the work before any monies are distributed to the contractors in that area. So all of this stuff is managed internally by us so that you guys don't have to do any of that. If you do need to foreclose on the note, we assist with you in that. If you'd like to sell that non-performing asset, we can help you transfer or exchange that asset. And all of this is, like I said, done through Lake City Servicing, our in-house servicing company. Okay, quickly. How do we generate first position loans? Like I said, they're short term, so we're looking for 6 to 24 months maximum. We're going to get appraisals on the property. We're going to do a background check on the borrower. We're going to get a credit report. We're going to fully underwrite the file. We are going to close with an attorney or a title company. We're going to wire funds directly there, and then we're going to monitor that investor's progress of the project over time. Then we service the loan. We then put that loan up for sale on our website. And when an investor wants to buy the note, we transfer it to the investor, which is simply an assignment or an allonge document. So one pager, we send it to you in DocuSign, you sign it, and then we just start cutting the monthly payment checks to you. So pretty simple, because you guys are going to receive monthly interest payments with payout at the end of the loan term. And that's the other neat thing, because our loans are relatively short, 12 and 24 months. And because these are fix and flip, it's not uncommon to have an early payoff. So you buy a 24-month loan, the investor gets the deal done in 12 or 14 months. Here's all your cash back, go redeploy it. So you have pretty good liquidity. There isn't these 5 and 10-year runways where you're waiting for somebody to go in and renovate and rebuild and increase cash flow. It's pretty liquid, and that's why a lot of investors like having it in their portfolios, for the liquidity and the ability to get access to your capital if you need it relatively quickly. So the life cycle is pretty simple. Identify the note. We then do the due diligence. We invest it through our private equity funds. We transfer the funds. We receive payments. Project gets complete. Then it gets paid off. Okay. Pretty simple. And then for loan servicing, Lake City Servicing, we collect and disperse your monthly payments. We'll monitor. We make sure that they have hazard insurance. So not only is your money protected by the real property, but it's also protected by the insurance policy. So in the event that that property burns down or something catastrophic happens to it, your insurance is going to cover your entire investment. So if there is a loss of value to the property, insurance is going to make you whole, which makes this even more unique to all of the other asset classes out there, because nobody insured me when Bitcoin took a dive and I lost 20 or 25 grand on that deal. In this business, that's what the insurance is there to do. So we monitor to make sure the taxes are paid so that the property isn't sold at tax auction. We deliver end of year tax reporting to you, or whatever entity is invested. We do a lot of work with private equity. We do a lot of work with custodial firms, equity trust, and many other IRA custodial firms. And we'll report all of that information directly to them. So it's really a great, for the most part, hands-off investment. You just need to tell us which one you want to buy. We'll take care of all the transfer docs, and then we'll set up the servicing and just cut you checks directly to you or your investment platform, wherever that is. Okay. Now, this slide is probably the most important. This is the slide that was a result of me losing pretty much everything in 2008. Because for those of you that lived through 2008, you remember that when the markets were just tanking and all of these credit default swaps were going into foreclosure and there's a for sale sign on every other house in every market in the country, the government came out with new loan programs, very aggressive loan programs for first-time home buyers, second-time home buyers, but anybody who fell below what's called the FHA cap. So in every county in America, roughly 3,300 counties, there's a separate FHA cap, which represents 80% of the buyer pool in that given market. And so when markets fluctuate and we see what we saw in 2008, the federal government is always going to throw money at FHA, VA, USDA, Fannie and Freddie. And they're going to make money available to people who want to buy a house to live in under the FHA cap. And so because of that, we set our entire underwriting criteria, and the only types of loans we will write and the only types of properties we will lend on are the ones that fit in this box. Residential 1 to 4 units, non-owner occupied, smaller than 2,800 square feet, smaller than 5 bedrooms, 3 baths, with less than a half of an acre of ground. So we don't end up with some 50-acre piece out in the middle of nowhere. We want these to be in relatively, large cities, 20,000 population or more. We want it to be close to a major airport. All of these things, we want to see income growth, we want to see population growth going on in these markets. But as long as the deal fits in this box, we can pretty much fund anything. And we do lend nationwide, which means we have notes all over the country. One of our recommendations to our investors is, hey, why don't you just buy a note in your own backyard, because you can drive by it, look at it, see how the investor is managing the project. But this has saved us. So this little box has been our guiding truth since 2009, when we went, okay, we just lost everything, we got to rebuild, but we need to do this smarter. And so we're going to build a asset class that is protected by the federal government, because, unfortunately for us, we were not too big to fail. So we said, okay, well, how do we set this up so that as markets shift, that us, our investors, our clients are going to be protected? And this is the one that does it. One of the jokes I often like to tell is, what do you call a private money lender in a recessionary downturn? What do you call a private money lender in a recessionary downturn? And the answer is landlord, right? Because as a private money lender, if we lend money to somebody that'll pay us back, we foreclose on the asset, and now we have a choice. We can sell it, but if the market isn't conducive to selling, right, it's soft, interest rates are high, we can just put a tenant in there and we can create cash flow waiting for the market to rebound. So either we're getting cash flow through the monthly payments by holding the note, or we're getting cash flow by owning the property and collecting the rents. So it really, really flattens the risk profile and gives you really consistent returns. And most of our loans, guys, are written between 9 and 14% interest. The average loan is about 11%. So imagine adding, $1 million of 11% returns, consistent returns to your portfolio. That's $110,000 a year, secured against real property, insured against loss. So many awesome upsides. I just love this asset class. I think everyone should have at least some of it in their portfolio. As you guys know, single family residential assets is always in demand. People are always going to need a place to live. People all want the American dream. They want to own their own home. And because of that, we see a lot less volatility in the markets. And that's our goal. That's what we want to accomplish. So a couple of examples here. Okay, this is a property in Birmingham, Alabama. You can see it's a 3-3, fits into the FHA cap, fits into our loan underwriting criteria. This is a $210,000 loan. We wrote it at 11%. The monthly payment is $1,925. So the borrowers flipped through other properties. They're employed outside of real estate. They made $178,000 last year on their tax returns. They brought $31,000 down, and their exit strategy is to fix it up and to sell it. So earlier when I was talking about a loan well underwritten is a loan half collected, this is a borrower that's got great history. They've already exited 3 other loans previously. They make really good money. They're not dependent on their real estate portfolio to survive. They actually have a job where they're making income doing other things. So this is kind of their side hustle, and they brought $31,000 down. Now, what is the likelihood that this borrower is going to default? And even if they did default, $170,000 a year on their tax returns, they're generating income, which means they have assets. So whoever buys this note is well secured, well insulated against a lot of the problems that we talked about that could occur, but because it was underwritten well, we have a very high expectation that it will pay on time as agreed, and it will pay off in the next 12 or 24 months. Okay, here's another one. This is in Petersburg, Virginia. Again, single family, 3-bedroom, 1-bath, 1,000 square feet. Loan amount was $129,500. This loan is paying 8%. This is a repeat borrower that's paid us off before. They've got a high credit score. They own existing rental properties, and they live in Virginia. Another key here is when you lend or write private money loans, you want to lend it to people who are investing in their own backyard. The best fertilizer for the garden is the footsteps of the farmer. And one of the things that makes us very nervous is when we're lending money to somebody in California who's flipping a house in Chicago, right? That's a very long ways to manage rehab. So our preference is that the investor live near the property that we're lending on so that they have a better handle on things, and we can rest assured that they're managing that project appropriately. Last one I want to share with you, this is a property in Indianapolis. This is a 2-bedroom, 1-bath, 1,500 square foot property. We lent $157,000 on this. The investor who buys this note gets 11%. That's $1,439 a month. The borrower lives in Indiana, has paid us off before, made $119,000 on tax returns. They've got good credit, and their strategy is to exit and sell. Okay, now these are all great. We talk about the returns. The returns are fantastic. But the thing that really I personally find rewarding in this asset class is we are lending money on properties that will not qualify for traditional financing. So these properties are often in a state of disrepair. They won't qualify for Fannie, Freddie, FHA. A first-time home buyer cannot buy them because lenders will not lend on it. But because we've trained the investor, we've taught them how to fix and flip appropriately, how to do the right things that make the house sellable and desirable to the end market consumer. They're going to be able to take this property, spruce it up, clean up the neighborhood, reduce crime as a result of that, and sell that home to a deserving first-time home buyer that's been, working on their credit and saving up money as a down payment and finally getting the opportunity to live that American dream. We're providing that service. And so over the years, we've funded almost $500 million in private money loans, almost 4,000 individual loans now across the country. And for every loan, that's a house that was in disrepair that's been brought up to livable standards. It's now financeable. And so I really feel like an investment in this asset class is serving other people. And that's ultimately our theme here at our company is we get more of what we want by helping others get more of what they want. And I like investing in things that help the market, help other people, create jobs. And I believe that this asset class does all of those things. So I want to give you guys this. If you go to securedinvestmentcorp.com/confident, I'm going to give you a download of our performing note platform guide. So what this is I think I've got roughly about 20 different sailors of notes. So if you guys are interested in this asset class, I would never assume you're only going to buy from me and only me. We'd certainly like it if you did, but not a requirement. I want to give you many of our other loan originators that are out there, give you an opportunity to look at their asset classes, what they have to offer, and find the note product that works for you and fits in your portfolio and matches your investment thesis and what's important to you as an investor, as a consumer. So I want to give that to you. So just go to securedinvestmentcorp.com/confident. All right. Sarah, I'm not sure how I'm doing on time. Am I good?
You're right at the mark. So there were two questions that kept coming up.
Okay.
So before you get off stage, I'd like you to answer them. One was about, do you do anything international? Do you work with international clients, students, and investors? And then the second was, do you have to be a student or go through a course to invest with SIC, or can people just invest with you guys?
Excellent questions. I'm so glad you guys asked. First question, yes, we will lend to international borrowers as long as the property that we're lending on is in the US. But we do max out our loan to value at 50% of the as is value. So we won't go over that simply because in the event of default, there's no recourse against somebody outside of the country. There is, but it wouldn't be worth the effort. So we need the property itself to absorb all of the risk. So we do limit the amount we'll lend on that to 50%. Second question, absolutely not. And I apologize. Obviously, I made it sound like you do need to be a student. You do not. Anybody can buy our notes. Anybody can invest in our funds. You don't need to go through our education curriculum or anything else. I only mentioned it to give you guys a comfort level about who these borrowers are. They are coming through our education. We do know them. We've worked with them. We've trained them, which makes the asset class even safer in our opinion. So.
Awesome. And what's the best way for folks to get started if they do?
I would begin by going to securedinvestmentcorp.com/confident, download that guide. And like I said, there's 20 platforms there that you can go look at online. Ours is one of them, Secured Investment Corp. And just look at the notes they have for sale. And if you guys have any questions at all, our contact information is on that white paper. Give us a call. Love to chat with you and see what we can do to help you choose the right selection of notes or assets to achieve the goals, whatever that yield looks like.
All right, perfect. Well, thank you, Lee. Will we see you at the end of the Q&A?
You will. I'm looking forward to it.
All right. So if you have any other questions, folks, write them on a piece of paper and bring them back for the last 30 minutes, and we will have Lee and everyone else on. Lee, thank you so much. I appreciate it. That was fantastic. And, we're so aligned in like, hey, if this works for you, great. If it doesn't match your investment goals, then find something else. Like, I love that that's your mentality, and that's ours as well. Let's show everything, and if it works for you, we'd love to work with you. So thanks for that.
Great. You bet. Thank you for having me, Sarah. I really appreciate it.
Thank you. All right, so I'm up next. Lucky me. Tough act to follow. Let me go ahead and share my screen. All right, so for those of you who joined after the 5-minute mark, I gave a little introduction of myself and Sugo Capital, but I'll give a little bit more of an intro, and then I'm going to talk about passive investing. So even though my story involves all different types of investments, at Sugo Capital, we connect investors to strong passive income opportunities. So we don't have courses, we don't sell anything, we don't have digital products. We have tons of education, and we have investment opportunities. That's what we do at Sugo Capital. So we have acquired 36 apartment complexes with our investor partners. And I'm going to talk about the structure of a syndication today. And know that what I talk about, I'm focused on apartments because that's what we do, but the entire concept can apply to almost any type of real estate. So if you're really passionate about another type of real estate, just know that you can probably find the same structure with that other asset class. So those 36 apartment complexes, to give you some idea of size, they're not 10 units. We have over 900 million in assets that we have acquired since 2019. And I'm on the advisory board of 2 other investment firms as well, besides Sugo Capital. So I already spoke a little bit about my journey, but I grew up, like maybe most of you grew up, thinking that the best way to financial freedom, financial success, is through getting a great education, going to a great college, getting a great job, and putting money into your IRA and 401k and live happily ever after. And my experience was I got straight A's. I got the AP stuff. I went to great college. I got, great job after college. And I still felt like I was living paycheck to paycheck. Well, that's also because I live in California, which is really expensive with high taxes. But I bet most of you could relate to that story. So in order to increase my income and increase my net worth, I went back and I got another degree. So I got my MBA from UC Davis, and I thought, okay, now I'm going to go get a better job, and I'm going to be so much closer to financial freedom. But the amount of income, the bump in my income for how much more I was working, it really didn't seem worth it. So I climbed the corporate ladder, manager, senior manager, director, and I was still working so hard and felt like I was really not getting ahead. And so that's when I started to study investments, how money works, and I went through several coaching programs, RA Mentor and Rich Dad, and they really opened my eyes. So I studied probably 25 different types or styles of investments. I'm going to talk about 15 today really briefly that I think are like the top 15. And then next week, we're doing an event, freedomin3.com, where I really go into a whole bunch of different types of investments and we compare them side by side. So we'd hope to see you on that event as well. So I talked about my achievements, but really what I am most proud of is that we have served over 25,000 investors through education. And that's through mostly through that series I talk about that we're doing next week, freedomin3.com, and it's the number 3. And we've had people go through that 3-day series. It's just an hour each day, and they have so many ahas. And my favorite comments are when people say, "You got me over the hump and into action to do some things that I've been thinking about doing for over a decade." And when I hear that, I'm like, that was totally worth 3 hours of my life to do that training. So at the end, you get a plan on how to take action and move forward with your investments. So we'd hope to see you there. So a little bit more about me and how I didn't stop. So this is a single family, actually this is a duplex that we rented, we bought and we rented out, and it's a before and after. And you might think the picture's in the wrong order, but they're in the right order. So it was a very nice turnkey property that we bought in Indianapolis. We live in San Francisco. About 6 months later, it was just trashed. Dogs had chewed up the banisters. Tenants hadn't been paying. They paid for 2 months and then just abandoned the property. We were living far away. We couldn't easily get there. I was working my butt off at my W-2 job, so I couldn't just like fly to Indianapolis tomorrow. And in the end, we lost 75%. We sold it at a 75% loss because now it needed work and it hadn't had income. But I didn't stop. And so I'm not proud, and I'm not proud of these results. It was just a piece of the journey. I decided I live in California. Having rental properties outside of California doesn't work for me. Having rental properties in California doesn't make math sense. So what else am I going to do? And so I turned to syndications and I started investing in hotels and apartments as a passive investor. And I was receiving 18 to 25% annualized returns. And I thought, well, this is way better. I'm not on the loan. Tenants don't call me. The property management company doesn't call me. Okay, great. So it is hands off. So like Lee was talking about, in syndications, you have zero input. There's zero liquidity. You're in for the 5-year hold or whatever it is. Everyone goes in together, everyone goes out together. And so it's not right for everyone. But at the time, since I was working and I wanted to put my money somewhere that I didn't have to think about because I had no responsibility for, syndications were perfect for me. And so I really loved investing in them as a passive investor. And then I love them so much. I became really evangelical about them and I started being on the active side, on the GP side. So what is GP side? What does that mean? I'll talk about that in a minute. You can see these are all the apartment complexes since then that we have acquired. And you can see our portfolio on our website that goes into detail on the size and price of all of these properties. I'm going to skip this one. I'm going to go into it later. I'm about to show in the next slide a whole bunch of numbers that have to do with returns. And so I want to say disclaimer, right? And also say I'm not offering any investment with this slide. I'm just showing you a comparison of what I've seen from my coaching that I've received and from my investments that I have personally made. And know that there are risks associated with investing, including principal loss. Nothing is guaranteed, so don't believe it if anyone says anything is guaranteed. All right, so we're going to talk about 15 types of investments based on certain criteria. And these are the criteria that I found are most important when you're first starting out and trying to decide what kind of investments are right for your portfolio. So you need to decide your goals first, right? And we'll go into that on Monday during freedomin3.com during our 3-day challenge. Really starting out with getting clear, writing down what are your goals? Do you need cash flow today? Do you need a check every month? Okay, then certain things are not for you. Do you really need to maximize your net worth in the next 5 years? Okay, annual ROI, annualized returns is what you would focus on. So these are really different. And setting goals for yourself based on your priorities, your lifestyle, where you are in your income journey are really, really important before you start looking at investments. So we have a chart where we're going to compare those. And then level of effort and risk. Lots of times people do not fully understand the level of effort. So like Lee talked about their, single family homes. Some people are like, "Mom, they're so easy." And he said, I'd have to get over 30 of these and I'd have to really get great systems in place to make the kind of money that I need to make. And I had that same experience where it's like, all right, I got cash flow of $300 a month from this single family home. It's going to take me a while to get where I want to go. And the level of effort of buying that many and managing that many was real. And then I felt like the risk was too high for me because one tenant moves out, I'm responsible for the mortgage for that unit, that home. And it was just too much for me. But it works really great for people who live in a market where they can keep an eye on their properties and the money works, the economics work, the economics don't work in California. So just being really real with yourself. Do you want to be hands off or do you want to be hands on? That's what I mean by level of effort. And then money needed to get started and hold period. What do these mean? So money needed to get started. So some investments that are passive investments, they have $1 million minimum investment. Some of them have a $250,000 minimum investment. Some investments have a $5,000 minimum investment. So before you really dig in and take time to explore some opportunities, make sure you look at the minimum investment and then hold period. A lot of passive investments are not liquid. And so really paying attention, because if you need liquidity, you do not want to accidentally get into a non-liquid investment. And with new passive investors, I have this happen all the time. They go into a syndication and then like a year or two later, they say, "Oh, my kid's going to college. Can I pull out my investment?" And you can't. Everyone buys the apartment together. Everyone sells the apartment together. So really pay attention to that. All right. Oh, and tax strategy. That's the last item, but very important. So some investments give you a tax advantage, reducing the tax you pay on your passive income. And some investments allow you to reduce your income tax on your active income. And so if you're investing as part of your tax strategy, there's so much you can do. And we won't get into that today, but just know that if you like that, we're going to talk about that in day 2 of freedomin3.com. So this takes me about an hour to go through. I'm just going to go through really quickly and say you can, when you're watching the replay, you can take a screenshot, whatever you want. Just know that these numbers always change. And depending on the market cycle, right? And so I put this together because these are kind of the norms when things go back into homeostasis. But we might be in this part of the cycle, we might be in this part of the cycle. And so these numbers will fluctuate throughout your investing lifetime, right? So make sure you look at these and pick out what's attractive to you, and make sure that over time you update what the numbers look like. So I'm going to go into what a syndication is in the next slide, but I want to call that out. So if you see apartment syndication, ATM funds, hotel development, all of these things, storage unit, mobile home parks, these are often offered as private investments in the form of a syndication. And so if you thought, wow, I didn't know I could passively invest in storage units, what does it look like? Okay, 20% ROI, 10% cash flow, cool. Level of effort low. If you're a passive investor, it's really, really low. You just send your money in and make sure you do your taxes. Risk is low. And so also this risk column, it changes depending on where we are in the market cycle. So make sure you are always paying attention to what the current risk is, not what was the risk 3 years ago. I'll just give an example, continuing with the storage unit example. Storage units are, when the economy is expanding, people buy more stuff. And so they get a storage unit to put their more stuff in. When the economy is contracting, people move into a smaller home or apartment, and they need to put their stuff somewhere. So they get a storage unit and they put their stuff there. And then 5 years later, they go, do I still have that storage unit? What the heck is in it? So it is a very sticky investment, and it does well in times of economic expansion and contraction. So that's why I say level of risk is low. Money needed to get started. Usually it's around 50K is the minimum to go into syndications like that. And usually the hold period will see like 10 years for storage unit syndications. Tax benefit, yes, there's bonus depreciation that can be passed through to investors to offset some of your passive income tax. So that's kind of how to read this chart. And I went into storage units just as an example. But again, next week, I'll go through each example in more detail. So what I did in my investment journey is I studied all of these. I put them in a chart, and then I said, okay, what works for me and what doesn't work for me? And what can I pick that I can create a portfolio around so that I don't have 100% of my portfolio in assets that have correlated risks. So if I only have, for instance, storage units, medical office parks, and apartment syndications, the biggest risk to those are the same across all 3 assets. So debt, insurance, taxes, it's been really killing the market lately, would kill all of those at the same time. And so I thought, okay, I need some assets that are not leveraged, so that if, debt spikes, it doesn't destroy my entire investment portfolio. And so when I looked at it, I studied, like I said, more than this chart. This is just a summary of an example of how you can think of different things. And then I said, what works for me that's not correlated? And so those things that are in the red box are things that I chose for myself. And these are things that Sugo Capital offers, because those are the things that I became very proficient in investing in. And so I encourage you to do the same for yourself. Find a few things that are not correlated to each other, and become a really, really, really good at due diligence and really good at understanding those types of investments, so that depending on what the economy is doing and where we are in the market cycle, you're going to put more money in oil, or you're going to put more money in apartments, or you're going to put more money in hotel development, whatever it is for you. So that's what I encourage you to do. So what is a syndication? I'm going to give you an example and know that the structure I'm talking about is a multifamily syndication because that's what we do. But know this structure is the same for funds, for real estate funds, for storage unit funds, for storage unit syndications, for medical office parks, for retail parks, for commercial, industrial. So really almost any asset class can go into the structure I'm about to explain. So a syndication simply means people pooling their money together to make an acquisition. And so when that's done, there's an LLC that's created, and the LLC will hold the asset. So in this case, it will own the apartment complex. And that LLC has general partners and limited partners. And the limited partners are those folks who put their money in, but have no decision-making ability. And so they're the passive investors. And then the general partners are folks like myself and other syndicators and sponsors who do all the work. And so we put some money in, but we don't put all the money in. And so we get equity for our work and investors get equity for our money. And how do we split it? I'm about to show you. So say we make this purchase for $1 million. So say there's a down payment, we need 300,000 and there's a loan for 700,000. Well, I would buy this all by myself and not share it with you because that would be a steal for this apartment complex, but I'm just using easy numbers. This apartment complex would be much more. So if these were the numbers, we could do it once, twice, maybe 3 times on our own with our own money, but then we would hit a limit, right? And so instead, what we do is we go out to private investors in our Sugo Capital community and we say, hey, would you like a piece of this pie for a financial investment? We'll give you some equity. And so how does that work? So I spoke about there's the general partners. So in the pie chart, I'm going to show the general partners are the orange piece. So that's me. And then the limited partners would be passive investors. So as far as the capital needed to make this acquisition, we like to get 60 to 70% of it from a loan. So that's taken care of. And then down payments mostly comes from the limited partners. So if we look at the circle is, the pie that of all the money that's needed, 30% of the money needed to make this acquisition comes from limited partners. Okay, so then how do we distribute the ownership or the equity? So again, investors are not a direct owner in the apartment building. They'll be an owner in the LLC that owns the apartment building. And so for contributing 30% of the money needed to make the acquisition, we give investors 70% ownership in the LLC that owns the asset. And then we keep 30% of the ownership for ourselves for doing the work. So know that this structure is just an example. And if you like this model of being hands-off and passive, when you go out there in the world and do your due diligence, it's really important to understand these numbers when you're looking at different sponsors and general partners for different asset classes. This is not a hard rule, it's just an example, so these numbers can fluctuate. Okay, so understanding that the two green pieces of pie are not the same size is very important because lots of investors wonder how, in a syndication, how do we get such a strong return at the exit? And it's because the investor partners receive a check for the appreciation on 70% of the asset, 70% of the asset's value. So 70% of the profit at the exit goes to the investors, the capital partners. And so it's not that, oh, you put 70% of the 30% of the money in, you get 30% of the profit. It's really a much larger piece of the pie. And so we think that's fair for everyone. And usually investors are very excited about that. So that's the structure. Then I'm going to give an example and know that this is just an example so you can understand terminology so that when you're out there looking for passive investments, if you like being totally hands-off, these are the key terms you need to know and in order to evaluate different opportunities that you see. So understanding when someone gives you a number and says, this is the returns, exactly what does that number mean? So if there's the word cash on cash, that means the check you're going to get every month or every quarter. And so cash on cash is actual cash flow from your investment. So if it says 8% cash on cash and you get a quarterly check, it does not mean you get an 8% check every quarter. That 8% is annualized. So it means if it's quarterly, you'll get a check for 2% of your investment value every quarter. 8 divided by 4 is 2, right? So you get 2% every quarter. If it says 8% cash on cash paid monthly, it's not that you get 8% a month. You get 0.666% every month. So that's really important. That's a common misconception I see with new passive investors. Annualized returns. So if an investment says targeted 20% annualized returns, that is very different from cash on cash. So it doesn't mean in year one, you receive 20%, a check for 20% of what you put in. It means that if at the exit, if you take all the money you've received from that investment, including cash flow, appreciation, everything, and you divide it by the number of years you were in that investment, it would come to 20%. There's also a common term, preferred return. And often people think the preferred return is the same as cash flow. I don't have that on here, but preferred return does not mean cash flow. Preferred return means the return that investors will receive before the general partners receive any profit. So it's the closest you can get to a guaranteed return. It's not guaranteed. It just means investors get that number before the general partners receive any profit on the investment. Important distinction. Investment profile. So there's all kinds of things. There's development. I had on the slide hotel development. Value add means it's an existing asset that someone's going to buy. They're going to renovate it. They're going to make it better and then resell it for a higher price, right? So it's like a fix and flip, but long-term for apartment complexes or for a retail park or whatever it is. So it's considered to be lower risk than new development because it's an existing asset you just have to improve. Often you can make higher returns on new development, but it has a higher risk. So that's, again, part of your journey of deciding what's right for you. Now, Lee touched on accredited and non-accredited investors, and this is really important for you to know where you sit. So an accredited investor means you have a net worth of $1 million or more, not including your home, or you have an income of $200,000 or more per year, or your household income is $300,000 or more per year. So it's an or. You don't have to qualify by all three. But if you qualify, the door is really, really open for you. And so when you're out there looking for investments, you can find 506Cs, Reg D 506C. You can look it up, but the SEC basically regulates how we can advertise things. So if you are an accredited investor, you can look for 506Cs or 506Bs. If you're not an accredited investor and you want to be in a passive investment, you have to look for a fund or syndication that's listed as a 506B. And some people do them, some people do not. So you need to find someone who offers 506Bs for non-accredited investors. Good thing to know about yourself. When you're looking at these, I already hit on this, but it's really, really important. Targeted investment period for passive investments. If it's 5 years, is it 10 years? Is it 3 years? Is it liquid? Is it not liquid? Make sure you really understand that and only put in the amount of money that you're okay being locked up and not touched for that amount of time. It breaks my heart when people say, can I pull some money out for my kids' college? And it's just not possible. It's not that we don't want to. So make sure, that's part of your responsibility to understand that piece. And minimum investment I touched on. So now I'm going to say, let's take this example and put it into a time chart and see what this actually means for an investor. So we're going to do an example of I take $100,000 and I put it into the investment you see on the screen. So it's at a 5-year hold. Okay, so I put 5 years on the left-hand column, 8% per year, 8% on 100. That's a cash flow of $8,000 per year. So if paid quarterly, it would be a check for $2,000 every quarter for a year. And so over those 5 years, I would receive $40,000 in the form of cash flow. Well, that's not nearly 20% annualized, right? So where does that come from? Well, if it was value add, okay, we bought an apartment complex, we remodeled it, we got a new property management team in there who are fabulous. We have all this great marketing, so our occupancy went up, our rent went up, and we're able to sell it at a big profit. And so proceeds from sale come at the exit, so at the end of 5 years, in this example, the investor would get a check for $60,000. So that would be their check for the profit split of the profit. And then also in this example, investors would have their principal investment returned so that $100,000 would go back to the investor. And so this is really key. Some investments do not give you your principal at the end. Some give you a return of principal at the end. Make sure when you're doing your due diligence, you understand which it is. Either one is fine as long as you understand it and that's okay with you. So if you take all the money from this investment, 40,000 of cash flow, 60,000 of appreciation, your $100,000 capital returned, now you have received $200,000. So that's an extra 100 that you received as profit and your 100 returns. So you turned your $100,000 into $200,000 over those 5 years. So annualized return, how is that calculated? In this example, you would say, all right, I increased my investment by 100% over 5 years. So 100 divided by 5 is 20. So this would be an example of a 20% annualized return investment. And so it's important to know the difference in the terms because you didn't get 20% every year. But if you take all the money you received and you divide it by the number of years you were in there, you got on average 20% per year. So knowing when you receive your dollars back and your profits is really, really important. So I think that syndications are great for people who do not have a priority of cash flow, but are really looking to maximize their net worth over the long term. Now, there's also often we do cost segregation analysis and investors get 30 to 60% of pass-through depreciation on their K1s that they can use to reduce the income tax they pay on their passive income. So that's just like a blurb. We'll go into that more next week if this sounds fun for you. All right, let's see, what do we got on the next slide? Okay, I know we have someone else coming up soon, so I'm not going to go into due diligence today, but know that due diligence is super important if you're a passive investor, and people do not do it correct in my mind. So I have these in a very specific order. People, market, property. People are the most important thing to do due diligence on. And I'm going to dive in next Tuesday. So it'll be day 2 of freedomin3.com. Really how to vet people and really how to vet a market, and don't just concentrate on the property and the numbers at the property, because the other 2 things are really the most important. So we'll talk about that next week. I'm going to skip through. And I keep talking about next week, what is next week? So my invitation for everyone on here is to join Freedom in 3 next week. So it's just freedomin3.com. And we're going to dive into some of the things I talked about today, but really go into what are your goals? Let's get really clear. What are your goals? What type of investing is right for you? Let's talk about due diligence, where you can find money to invest, how do you invest your 401k, and everything that people are going to talk about today, how to use your IRA to invest in everything, 1031 exchange, trust, all these wonderful things. We will do a lot more and a lot more in-depth modeling returns. So I showed one example today. I'm going to go through about 8 different examples so you can really understand the nuances of different types of investments. So you know the income you'll be able to generate from them and when you get that income. And then we're also going to talk about how to create a really actionable plan and talk about the next steps to implement your plan, because lots of times you walk away from this and you go back to your life and nothing changes, right? And so we really want you to create an actionable plan that will propel you on your investment journey to get you closer to your goals. And so at the end of the freedomin3.com, the 3 days, we'll have that really clear for you. So with that, I'm going to stop sharing because I think I'm a bit over time, and I'm going to invite our next speaker, Eric. Go ahead, turn on your camera. Cynthia, if you can make him co-host so he can turn on his camera and share his presentation. All right, an intro to Eric. So Eric and I met, it's almost 2 years ago, maybe a little bit less than 2 years ago today. And Eric was actually with an oil company at that time that I invested in, and then ended up partnering with that company. And so Eric and I worked really close together for about a year around the investor relations side of that fund. And so I got to know him very well. And our investor community just blown away by Eric's knowledge of macroeconomics and how he takes really complex world events and boils them down really simply into what does it mean for me and what does it mean for me today and what should I do about it. So I'm really excited about your talk today, Eric, and thank you for being here.
Well, thank you, Sarah. Yeah, nothing but good things to say. Thank you for having me today. I think these conferences online are really important to the future of investing. Investing is getting more difficult in many areas and very simple in other areas. And I think what the area I'm going to focus on today is Bitcoin. I'm no longer with oil and gas, but I'm using that expertise and tax structure for Bitcoin mining now. And I'm going to go through my thesis of how I came to Bitcoin. And before I start, it's always important, be vulnerable on things. 10 years ago, I was given a slot on a stage to talk about Bitcoin. I was given 3 days notice to study Bitcoin and give a presentation. It was the worst presentation you'll ever hear in your life. And it was terrible. And I completely disregarded it for at least another, I don't know, geez, 6, 7 years. And then in 2020, right around the time Michael Saylor and some other big names got involved, we had time during 2020. So I'm a bit of a historian, and I started digging through and seeing what's there. So I'm going to run everybody through a Bitcoin basics boot camp in very simple form. So if you'd like me to start, I'll go ahead and screen share.
Yep, go for it.
And this is a special occasion. I will say this: I generally don't do PowerPoints. I'm a podcaster, so I just talk. So I'm hoping that this will turn out well. I did this for you guys here, special to do a simple thesis on Bitcoin. So let me get it
Excited.
where we are full screen.
All right.
All right, we seen okay?
Perfection. Thank you, Eric.
You got it. You got it. So thank you, everyone. A little bit about me, my background. I've been in very high-tech stuff most of my career. I'm a multi-time entrepreneur. Plenty of successes, plenty of failures. I spent a bulk of my career learning complex things like patents and technology to explain it to the investor world. Like Sarah said, I'm a macro guy. I have a free podcast, doesn't cost you anything, called The Rice Report on YouTube and Rumble, now on TikTok Live. And I do this stuff because I love it. I love the game theory. But my last business was oil and gas. I went into that for a specific reason. I think it helps the country. We need oil and gas. People need tax benefits. You need cash flow and returns. And along the way, I realized the intertwining between Bitcoin and oil and gas, which I'll get to near the end. So what I plan to do for us here today is run through my thesis in very simple people terms. There are so many people in the world that will explain Bitcoin in the most complex algorithmic language that unless you're a developer, you're really not going to understand, which is why this saying is so important. Bitcoin literally is everything people don't know about computers combined with everything they don't know about money. And money is a topic we don't talk about. My podcast is that 3 topics: money, politics, and religion. The 3 things you're never supposed to talk about, I talk about 4 days a week. And it's fun, and we should all do it because it's great conversation. But before we can get into understanding what Bitcoin is, we have to have a basic understanding of the history of money. This is so important. No one takes the time to do this, myself included. Before I start this section, I would highly advise getting a book called Thank God for Bitcoin. It does a very good explanation of the history of money, and also the Bitcoin Standard by Safe Dean. These are 2 Bibles in the new version of the financial system, which is certainly on its way. So the history of money. You can date back to 9000 BC when people started bartering. So if you had something and you needed something, you could trade it. Eventually, they started getting into shells and rocks, and it was always based on something that was scarce. Value is created by scarcity. That's a format that we have long forgotten in this century, that value is always created by scarcity. So shells, rocks, stones, statues, crafts, these things were all made as money. Eventually, they started finding metals. Around 700 BC, and eventually metals were difficult because they were just a clump of silver or a clump of gold, and you'd have to go to a merchant who would have to have a scale, and there's no way to divide it, so you'd have to buy more goods. And eventually the merchants started tipping their scale and robbing from customers. So the government, as governments always do, comes in and says, we'll fix this entire problem. And they created standardized coins, which ultimately got clipped. They started taking pieces of the coin. They started minting gold with copper and making it look like gold and keeping the gold. Should sound familiar to today's world. And then they invented paper money and they backed it by gold, which no one can actually verify or prove that any government has. No one's ever actually done a full audit. And then the Bretton Woods system came in 1945, right after World War II. And that system was designed completely around partially backed money. And in 1971, we went on full fiat standard, meaning that our money right now is nothing more than a debt instrument of a central bank who is a private corporation and actually not part of this country. So the advent of money, the understanding of the history of money is crucial to understand why Bitcoin exists as we go through some of the basic properties of Bitcoin and money itself. Now, this whole process has led us into coin clipping, gold-backed money, and now we have just excessive money printing. 54% of the money supply that exists in America today has been printed in the last 6 years. With the drop in interest rates yesterday and the irrational exuberance happening in the market today, I anticipate them at least trying to print anywhere between $4 and $6 trillion over the next 12 to 18 months to support multiple foreign wars and a lot of unfunded liabilities from the government. So this is a really big problem to focus on, especially as an investor. There's investments you make, there's cash you hold, and there's cash equivalents that you hold. And I view Bitcoin in my thesis as a cash equivalent. So after understanding the history of money and just how bad it gets, because it starts out peer-to-peer and it ends up being government regulated and fully centralized, and then that centralized authority has ultimate power. So power always corrupts, absolutely, right? Absolute power corrupts, absolutely. And so in the 1980s, a group of developers called the cypherpunks created a manifesto. They started working on computers in the original era of the internet. The manifesto they wrote is actually interesting if you have a chance to read it. It's basically a bunch of guys who worked on a computer who were fed up with the real world and with governments in general and the way money worked. So they started using computers to interact with one another and create forms of currency using a new technology called cryptography. Now, this is something that went on for the better part of 20 years. I think most people think Bitcoin just started. It just popped up out of nowhere. There were 40 to 60 attempts to create peer-to-peer e-cash all throughout the 90s and the early 2000s. But I think the financial crisis of 2008 really opened people's eyes to the fact that, wow, the government can just print money while we have to work for it. So on October 31st, 2008, an unknown person under a pseudonym called Satoshi Nakamoto wrote a white paper at MIT about how he thinks you could build a successful peer-to-peer electronic cash network, which after the course of a year and a half of developing, by the way, all the emails exchanged between the developers are now public knowledge. So we're kind of getting through that mystery of who created it and who's behind it. But it launched on January 3rd, 2009, right in the middle of a financial crisis. And it was designed originally to be a peer-to-peer money network. But again, what is money? Money has distinct properties. And the conversation of what is money, there's a gentleman named Robert Breedlove has a great podcast called What is Money? And they talk about all kinds of different things. And money has specific properties. It has to be durable, portable, divisible, fungible, scarce, verifiable, and have a track record. Now, two other components have been built into this properties of money model over the past couple of years, and that's censorship resistant and smart or programmable. But as you can see on this chart, I'm not going to walk through that. I've got to condense years of research into Bitcoin into 40 minutes for you. So I'm going to try to be as concise and clear as possible and really get to how it works. I think if you understand how it works, it removes the complexity. But if you look at durability, gold, highly durable, fiat, paper is moderately durable, Bitcoin is digital, it's very durable. You'll find out that Bitcoin fits the criteria of the property of money better than anything else in the market, especially divisibility and portability. So gold, I love gold. I started out on this journey in 2019, realizing that we're heading into a market crash of some sort, which is going to happen either later this year or next year. I'm certain of that, and I'll show you the stats. But how do we get on? What's the off ramp? I was looking for an off ramp from centralized money, centralized currency in general, and gold is where I went first. And when I started realizing that you could have all the gold in the world, but in order to sell it, it's not very liquid. And at the same time, in order to sell it, you've got to have a van or a truck, and you could get robbed wherever you go. And that's where I really found Bitcoin as a better version of gold or digital gold. But it's important to understand the properties of money. And if you want this presentation, it's very simple, but we can certainly mail it to you afterward. So the money problems that exist. We live in a centralized system. We have a central bank, which we talked about, that has basically three main purposes. A central bank is supposed to manage the money supply, which they're not doing. They're inflating the money supply, creating inflation. They're supposed to manage monetary policy, which changes by the minute. It's not immutable, and it requires no voting. There is no voting. It's centralized. When they want to change monetary policy, they change it. You just saw that yesterday. A small group of men decide to raise or lower rates based on their poor performance of distributing money to the world, and it just happens in a silo, and they tell you later. That's centralized control. And transparency. The Federal Reserve has never been audited. 111 years has never been audited. What they produce, the product this private corporation produces to this country, is currency, fiat currency, pieces of paper saying you owe us money later. And this creates a constant debasement of your value. In fact, most of the things that we invest in, especially tangible assets, they don't actually go up in price. The value of our currency depletes. So it costs more to buy the same thing. And the thing that people overlook is that it's very easy for a centralized authority to confiscate or censor your money. They confiscated gold in 1933. That was Roosevelt. Last year, they enacted a system in this country that most people don't even know about called Fed Now, which they tell the general public is used for them to be able to make faster payments 24 hours a day between banks. But if you read the actual bill that was passed, you'll find out that right now, every single three-letter agency in this country has full access and transparency into your bank accounts, trading accounts, and everything else. And we've seen censorship with the Canadian truckers and multiple people around the world where governments basically say, we don't like what you're doing, we're freezing your accounts. These are really big threats to your own sovereignty and your wealth that most people don't pay attention to because life is so busy. That's kind of why I exist in this world as a podcaster. And now we're starting to see that our money system is not really secure. All of our name, address, and social security number was just hacked 2 months ago. So right now, every single person on this call today, all of your information is now on the dark web and can be used by hackers. And we've already seen about a 30% uptick in identity theft since then. So the bottom line is centralized control always requires trust. You must trust the human beings involved who have absolute power that corrupts absolutely. Best way I can explain centralized power. So Bitcoin is a solution. It is certainly a solution. I think it's the solution. First and foremost, it's a series of open sourced protocols. Open source meaning anyone can see it. It's totally transparent. Anyone can see that. And the protocols are set and designed to be voted upon. So the way that Bitcoin works today is completely trustless. There's no human being involved in the actual transactions or documentation or ledgers. And more importantly, to make a change in Bitcoin, you need to have consensus, a vote. Now, the world, I don't anticipate Bitcoin changing in a big way ever over hundreds of years because human beings have a difficult time determining who they want to vote for in an election, yet alone their own money system. So I look at it from that way. It has a finite supply. It's extremely scarce. There are only 21 million Bitcoin that will ever be created. Almost 20 million have been mined and released to the market today. By the way, every Bitcoin breaks down into 100 million divisible units called Satoshis. So you don't need to buy a full Bitcoin, just get some Bitcoin. It'll serve you well. It certainly acts as digital gold. It's highly liquid. So Bitcoin is far more liquid than gold. You don't have to transport it anywhere. You can push a button and you can liquidate and get cash in your bank account that day. But the properties of digital gold, I'll explain a little bit later near the end. It's important to remember that gold was used as a currency and then it was used to back currencies. So digital gold has many implications. The most amazing part of Bitcoin, I'm not really much, I came to Bitcoin myself, the currency, by understanding the system and how it derived its value as a currency. So the system itself is immutable. So once a transaction occurs, it's verified in a thorough process to make sure that nothing is double spent or any counterfeit. Once it goes on the ledger, it's there forever. No one can go back in and change a transaction or steal from you. So this large, immutable, open source, visible to the public ledger of the way money is moved around the world is very important to sovereignty now and in the future. And it's audited. So Bitcoin is audited literally every 10 minutes. So a Federal Reserve never audited in 111 years, run by human beings you have to trust. Now you have a system that's fully transparent, audited every 10 minutes, and it is trustless. The money on the system cannot be censored. It cannot be confiscated. It is highly secure. The mining process, which I'll explain with a cartoonish illustration, creates the most impenetrable digital wall that exists on Earth today. It is literally the world's largest supercomputer. And that security creates a lot of value, and it requires consensus for change. Very important to understand. So let me preface this before I get into Bitcoin by saying I'm talking about Bitcoin, not crypto. There's a reason they call crypto altcoins. They are an alternative to Bitcoin. Bitcoin works on a system called proof of work. And I came to Bitcoin because I was a gold person. And I said, why would I buy any coin that you don't have to mine? All things of value that are considered commodities, which Bitcoin is, are mined. So if you don't mine it, it doesn't have any value. Proof of work is a meritocracy system. It is a democratic system where everyone contributes and produces the end result. And everyone who does mine and contributes to the system actually has skin in the game, whether they've bought the currency with cash or they've bought mining units and are paying an electric bill to mine in the system. Everyone has skin in the game. And the way it works, which I'll explain in a minute, is designed for a perfect incentive structure. Almost everything in the world should work on this type of incentive that wants to be successful. It has the highest security in the world, and it has a true fixed scarcity behind the exchange of value, which simply hasn't existed on planet Earth, at least in our lifetime. So it is rules without rulers. The hardest concept to understand is that Bitcoin is decentralized. We live in a centralized world. The government makes money. Insurance companies make insurance. They work with them. Everything is centralized. It's controlled by a few, used by all. Decentralized means controlled by all, used by all. It is truly the idea of freedoms for money for we the people. Bitcoin is rules without a ruler. There's no CEO, no investor, no venture capitalist, no board of directors, no human beings that can corrupt the system, no foundations, no insiders, no office space, no website, no marketing team, no executive team, and no central control mechanisms. It is truly decentralized. It is literally the only and first truly decentralized system that humanity has ever seen, which is rare and difficult to understand. Track record, just some highlights before we hop into it. So again, first and only truly decentralized money, first commodity, digital commodity with full legal clarity. The SEC has gone through this with Bitcoin for 10 years, full legal clarity. Fastest asset in human history to $1 trillion. It's now more valuable than Berkshire Hathaway. The most successful ETFs in the history of the stock market have all been Bitcoin. The adoption rate right now is picking up to be faster adoption than the internet when the internet came out. And it is the world's largest computing network that we have ever seen. Hash rate, which I'll explain in a minute, creates kind of a force field of security around the system. And it is the hardest money on earth. But how does it work? So before I explain how things work, I've got some good definitions in here for you. Decentralization, again, controlled by all, used by all, not controlled by a few, used by all. Cryptography is a way of using coding or mathematics to ensure that a lock and a key fit perfectly. If the key is even slightly off, the lock will not fit. So it is a system designed to create privacy. This was the premise behind the entire movement towards digital money, is to have privacy involved with your transactions. And then there are nodes, which I commonly call quality assurance. Nodes are essentially computing units that hold the entire Bitcoin network on their computer. I run a node in my house. If the power went out tomorrow, I in my home could reboot the entire Bitcoin network right where it was when the power went out and get it right back online. My single computer, my laptop could do that. Truly decentralized. And then you have miners, who I call quality control. These are the folks who confirm the transactions and assist in the auditing with the node holders. And they are incentivized to continue creating homeostasis within the system. And of course, the term blockchain, people confuse this and make it difficult. It's a ledger. It's a public ledger run on a digital system. It's just a recording of all the history that's happened within the system that cannot be changed. And all of that creates value that drives value to the hardest money on earth, the BTC, Bitcoin. The system creates the value for the money. It's not the other way around. So what are Bitcoin miners? They are transaction validators. And I'm going to get into an illustration. I have 3 of them that I'm going to show you because I want to make Bitcoin mining is the most difficult thing to understand. And most people have no idea what a Bitcoin miner is or what they do. And I hope to make that easier for you here today. So essentially, Bitcoin miners validate transactions. They get a new block that they compete for every 10 minutes. The way that they compete is pretty simple. You have a computing unit and you have Bitcoin. When a new block comes out, it has a very difficult math problem or a password that's associated with it. So millions of computers around the world are competing to solve this difficult math problem. They're literally making 200 to 300 million guesses every 10 minutes to try to win a block. And that combined computing power is right now, this morning, 641 exahash. That is the equivalent of pretty much the entire energy of any major nation, protects and maintains the system. This is truly a vault for money. And the incentives right now for a Bitcoin miner, so if they win the block, they verify, they do their job, make sure that everything is good, they get paid by Bitcoin, by the system, 3.125 Bitcoin per block, plus transaction fees. This is not a small industry by any measure. Last year, the Bitcoin mining market made $65 billion in profits. So again, the process. Every new block has a password. They have to make millions of guesses. The winner validates the block. The nodes verify the block with them. Then the block is placed on the chain and incentive is paid out. And miners do work in pools to increase the odds of them getting paid, because you could mine forever and never actually win a block. Now, how it works, I can say that with words, but I think that illustrations are very important to have. So the way that I think of the Bitcoin network, the system itself, and I tried to make this super easy, you'll never hear this anywhere else. I think of the Bitcoin system like a factory with an assembly line. So you have a box, a package, or a block that is being filled with transactions that comes out with a password and a difficult math problem to solve. Every one of the miners in the world is competing, increasing hash rate to be able to verify or validate that block. Eventually, one of them wins. So now they have this box that's filled with goods, just like in an assembly line. The package is full. Someone filled the box. That goes to quality control. Quality control verifies in the system that every single transaction is legitimate, that every cryptography key matches, and that there have been no counterfeits. Basically what a central bank should do with every transaction, but doesn't. And when they win that block and they validate, they then have to send it out to all the node holders, all the decentralized computing units that follow the same code. And if every single one of the nodes out there approves on the system, if every one of them agrees that this is now a perfect transaction, then the Bitcoin miner gets 3.125 Bitcoin from the system, fresh, new minted Bitcoin. These are going to be extremely valuable in the future, but there's also transaction fees that the Bitcoin miner makes. So another way to think of it is very simple. People mine, you have the box with filled with transactions, you verify that everything in that package is good to go, you quality control, quality assurance, put it on the blockchain, it's now immutable and recorded forever. And then there's an incentive paid. This is what's called proof of work. You must do work and contribute to the system in order to get the incentive. This is truly the way businesses should be run. So miners get paid, right? That's an important process. If miners didn't get paid, there would be no Bitcoin in the system. Unlike crypto, Bitcoin has never been given away. Every single Bitcoin on the market or that will be released in the future, someone had to spend money on energy, a computing unit, and spend a significant amount of time mining. So every person who's in the system has actually been rewarded for their merits. And their merits decrease over time. So as the network effect right now, again, the network effect of Bitcoin is the largest supercomputer that the Earth has ever seen. This network is growing and expanding and further decentralizing down the road. But the thing that happens every 4 years, now there's a mathematical way to do this, but they work out to be every 4 years, the incentive for the miner who does the work to make sure that everything is good, their incentive gets cut in half. So I'm sure at least earlier this year, you heard the term halving, and most people don't know what a halving is. A halving is once you've reached a certain point, the miner incentive gets cut in half. Now, this is a perfect system in incentives because as the incentive gets cut in half, the price has escalated. So as you can see in 2009, when Satoshi was mining blocks, he was getting 50 Bitcoin for every time he mined a block. He got 50 Bitcoin. There were 7,200 Bitcoin going into the market every day back then with a price of less than a penny. Fast forward to 2024, where we are today, Bitcoin miners now get 3.125 Bitcoin per block. There are only 450 new Bitcoin that get created a day. That's it. There's only 450. And 3 years from now, that's going to go to 225. But the price has escalated from less than a penny to $62,000. That is the top performing asset in the world over the past 15 years. Now, the timing for understanding a system like this couldn't be better. This is a liquid product, a money, a store of value. It's easily transferable from one person to another. It takes a little learning to know how to do that, but it's a way of storing capital. So a lot of folks right now are using Bitcoin as a holding cell, earning their upside on Bitcoin and then deploying that capital into, homes or real estate or oil and gas or stock. But the timing is perfect. With all the geopolitical unrest, and I won't get too much into that today, as you can come to my podcast, I do it 3 or 4 days a week. Geopolitical unrest is a big thing to think about. We have the verge of war. We have a multiple wars around the world, on the verge of us being involved in one of them, in my best estimation. And along with that, we also have an election season coming up, creating more geopolitical unrest. I'm sure all of you have a TV, the internet, or a phone, and you realize how much tension there is in this country. And in the middle of this, we just saw a 50 basis point drop in the federal interest rates. Now, the last two times they dropped 50 basis points was '01 and '08. Both of those two seasons, those two drops at 0.5% produced in 2001 a 39% decrease in the S&P 500, along with the 2.5% increase in unemployment. In 2008, it was a 53% drop in the S&P 500, correlated with a 5.4% uptick in unemployment. These are things that are coming down the pike. These are pretty mathematically solid. But dropping interest rates guarantees that it's cheaper for the government to borrow money from the central bank. So you can guarantee that more money printing is coming, which is going to debase your currency all over again. So a whole new cycle is coming. And we are now almost $36 trillion in debt. And in the last 2 days, we've actually printed or borrowed $82 billion as a government. So the debt spiral ultimately ends up creating bank runs and bank failures. These are big things to track. I'm going to show you a chart at the end. And ultimately bank bail-ins, which most people haven't heard of. I talk about it a lot there, but these are laws that are set. You can't bail out banks anymore, give them free money to make sure your money is safe. A bail-in now, per the Dodd-Frank Act, essentially says that, well, your money is actually debt to the bank because they owe you money when you give it to them. So a bank bail-in is when a bank converts debt to equity. So instead of getting your money back, you get a stock certificate for a failed bank. This is not a theory. This has happened in Cyprus and Malta. It just happened in Cuba. These things will happen throughout the course of the next year. Plus, we live under a very large state surveillance. So everything we do is watched. I just explained FedNow, and it's easy to censor our money. And we're already living in a deflationary economy with Bitcoin. So my home I bought for $750,000 4 years ago. I'm in Texas. So if you're in California, you're like, wow, how'd you get a house that cheap? Back then, $750,000 would have cost me 43 Bitcoin. I can now sell my house for almost double that amount for 21 Bitcoin. So while everything else is getting inflated, Bitcoin is scarce and fixed, and it's deflating against buying power of any currency in the world. At the same time, we're seeing supply. Supply is always an issue. This is a commodity. So in supply, it's important to note that 71% of all the Bitcoin in the world has not moved in 9 months. It is being held in cold storage. I always thought Bitcoiners were crazy, right? This is their community and they just love it. Once you understand it, I also have not moved Bitcoin in 2.5 years. I just keep accumulating. I don't sell any. But more is also being taken off of the exchanges. So right now, what most people know is they go to a Coinbase or a River. I would advise River or Strike. Those are the two best Bitcoin exchanges with great fees and great service. People go there to buy Bitcoin because, again, unless you're a miner, you have to buy Bitcoin from someone else. They can't be created or counterfeited. But the exchange rates right now, they're projecting at the rate of purchase through pension funds and ETFs and all these other things that the exchange supply will actually deplete to next to zero within the next 9 to 12 months. At the same time, only 450 Bitcoin are being produced per day. So you're watching a great supply crunch as an investor to look at. And I think it's just perfect timing with the demand growing the way it is. Again, 71% of Bitcoin has not moved in 9 months. These are not people sitting on Bitcoin. They're people like me who buy every couple of weeks, or if it dips, I buy a little more and I keep it in my vault. ETFs and pensions and now institutions, also governments and nation states are getting involved. I personally know that yesterday a gentleman met with 40 states, 40 different US states, talking about purchasing Bitcoin on behalf of the state. I was at Bitcoin 2024 when Donald Trump said very boldly, don't sell your Bitcoin. And he has a plan in place, if he's president, to purchase 1 million Bitcoin from the market to use as a national stockpile. So many other uses for Bitcoin beyond money. I can go into that into an episode on the podcast. But for today, understand that demand is growing while supply is depleting. It's super important. Now we're watching the growth of peer-to-peer. Until now, Bitcoin has been kind of a peer-to-peer, but more of a store of capital. But peer-to-peer is growing. Donald Trump just bought a hamburger in New York City with Bitcoin using the Lightning Network, which I thought was fantastic. And then you also have inflation and interest rates and international sanctions. People ignore this all the time. Central banks in what we consider hostile countries, They've been stockpiling on gold, and the gold supply is running out. So now they're stockpiling on Bitcoin because they can use it as a way of using cross-border payments without going through the US dollar, the SWIFT system, or any centralized control from the sanctions. And then concerns of privacy and censorship are very much on the rise, as they very much should be, with all the conversation happening in the world about a potential CBDC, which is not potential, it's potential here. But there are CBDCs being implemented in 5 different countries in Europe, and most of Asia is preparing to launch out CBDCs, which is truly the end of financial freedom. So we have all this supply and demand crunch, and the supply and demand is just overwhelmingly simple to see. But how has Bitcoin performed when things go into crisis? We are very much in a crisis mode, hostile election, violence overseas, wars, things like that, collapsing economies all throughout the world. How has Bitcoin performed? This was actually put out by BlackRock 2 days ago, and it's a very good breakdown. So we're approaching an election season. The last election season, it was pretty easy to see. 10 days after the election, Bitcoin was up 19%. After 60 days of the election, Bitcoin was up 131%. I think that had a lot to do with the changing of the guard and the potential of what we're seeing now, fallen economies and poor economic performance. Invasion of Ukraine, that produced -6 in 10 days from the initiation of the war. After 60 days, Bitcoin was up 15%. Keep in mind that your savings account still produced 2 or 3% at that time, so it was a very small amount. And our U.S. regional banking crisis from last year with Silicon Valley Bank, you saw a 32% jump over a 60-day period. So I don't like when people say it's a safe haven or a hedge against inflation. Bitcoin doesn't really have any correlation. It is its own independent financial system and the only alternative that exists in the world to central banking. And you're still able to front run. I think the most fascinating thing about Bitcoin is the fact that it was created for the people, by the people. And I'll get into the conspiracy theories about Bitcoin at the end. But the mere fact of the matter is the system launched in 2009, and until the last really 6 or 7 months, it was almost completely owned by individuals. And now, even after all the ETF buying, there are 6 or 7 different states buying Bitcoin in their pension funds. Almost every government in the world is buying the ETFs as part of their pensions and endowments. They just haven't released that publicly. And now we're still at 60% of Bitcoin is still owned by individuals. 19% is on exchanges, whether that's available for sale or not. If you have Bitcoin on an exchange, get it off of the exchange. These are not secure environments. They're highly centralized and easy to hack. 10% of the overall Bitcoin, this is 2 months ago, was owned by the miners. The miners have been selling privately to the institutions, keeping the price down while they filled their bags. I can prove that 6 ways to Sunday. So that time is almost over as well. So you have a supply crunch. Miners don't have much to sell privately outside of the exchanges. And the exchange supplies are also dwindling. But it's the first $1 trillion asset in the history of mankind where the little guy got a shot at it before the big banks and the nation states. So that's a pretty good description of Bitcoin, where it is. And it's so important to make it simple to understand. Bitcoin is nothing more than open source protocols that act like a quality control, quality assurance assembly line to ensure that everything is legitimate and that everything is recorded with full immutability, can't be changed, and full transparency to the public. That's a very important thing to understand. Now, Michael Saylor, who is the CEO of MicroStrategies and one of the most successful investors in the world, was much like me. Until 2020, he thought Bitcoin was really dumb. And once you really started to see what was happening with inflation beginning and watching the debacle we've seen in our economy over the past year or 3.5 years, people have gotten more interested in understanding, how do I protect my wealth and keep it safe from thieving hands of a government? So Michael Saylor recently came out. I saw him speak in Nashville as well. He has just given a target of Bitcoin at $13 million by 2040. And to be honest with you, 5 years ago, that would have been a ridiculous claim. And today it's actually pretty mathematically sound when you look at the supply, the demand, and then the decrease in all fiat currencies throughout the world. It's really actually a pretty logical and fairly conservative projection by 2040. In the end, I believe that I'll get that in the end. It's also used with full legal clarity as a treasury reserve asset for corporations. There are now 65 different public companies that are housing Bitcoin as a way to produce shareholder returns. All of these companies have gone up 30 or 40% because they're protecting their company's wealth against inflation and debasement. So it's being used by corporations. Governments are doing this. Many, many nation states throughout the world are very involved in Bitcoin. In fact, El Salvador is the most well-known. They made Bitcoin legal tender about 3 years ago. 3 years later, they've now mined millions and millions of dollars of Bitcoin using volcanic energy with no carbon emissions. And that country announced yesterday that they are no longer borrowing money from the IMF or any other foreign entity, that they will fully finance their own independence as a nation. This is a movement that will catch on throughout countries, especially smaller ones, very soon. Argentina is kind of on the same path. Colombia has been talking about it. There's a lot of nation states that are seeing the value in controlling their own destiny as opposed to being beholden to a private central bank. So many governments around the world are doing that. It will surpass the market cap of gold. I've heard everyone say that, and that's what got me interested in Bitcoin because I'm a gold bug by nature. And it is pretty mathematically possible. You know, gold is around $12.5 trillion market cap right now. That's a 12x from where we are over a 15 to 20 year term, with the most scarce asset in the world, with really, really accelerating demand. I can certainly see that happening. Legal tender is huge. 10 countries allow it as legal tender for contracts and purchases. The state of Louisiana yesterday just opened up a portal on the Lightning Network where you can now pay for your state taxes, your driver's license, anything you want with Bitcoin. The adoption is accelerating faster than I thought it would at this point, which is amazing. But at the end of the day, my opinion, these are projections from other people. This last one is me. At the end of the day, what I see is Bitcoin being used as a pegging instrument. So again, digital gold. We used to use gold as the base layer, and then we would print money against the gold, and you could redeem that printed money for gold. Well, that's extremely difficult to do in today's world. It's expensive. Fuel costs a lot. You don't want banks to have, a ton of gold sitting in their vault because they're going to get robbed. You don't want to carry gold around. You're going to get robbed. I see in the future, and it's not tomorrow, it's down the line. I see countries that want to create self-sovereignty, ultimately buying big swaths of Bitcoin and then leveraging their own national currencies aren't going away. I'm not of that opinion. But I do think that instead of, right now it's a fiat world. The only competition you have is your fake money better than my fake money. And that's usually determined by your economy and your military. But in the future, places like El Salvador are working towards using their Bitcoin stockpile to back their own national currency, so they don't need to be beholden to a global world reserve currency. I see that being the future for national currencies 5 to 10 years down the road. I think we'll see the first beta test around then. And then ultimately, I think it could be used as a world reserve asset for all currencies to be backed by, because it's immutable, scarce, unconfiscatable, and uncensorable. So helpful tips. There's only a few ways to get into Bitcoin. It's not like any other industry. You can either buy Bitcoin by itself. You can trade it. That's certainly I don't trade it. I don't see the point in trading that. I will trade any other thing. You can get involved in trading. You can own it. You can hold it, or you can get into mining, do it yourself, invest in a miner. It's what I do. I'll do a little tiny thing about that at the end. Or you can simply be an observer. Eventually, you'll be able to write options. You can buy an ETF. I advised everyone to own real Bitcoin. Do not buy ETFs. That is paper money. This is what they did to gold. Gold used to be something you exchanged on your own that had value. And then they created a paper market. And that paper market is rife with fraud. In fact, 9 JP Morgan bankers are serving 20 years in prison for rigging the entire metals market over the last 20 years. It's pretty simple. You have 1 ounce of gold. You sign a contract for 1 ounce of gold. And since no one ever collects physical gold because it's hard to transport, what these traders do, or these entities do, is they write 100 more contracts against that gold because they know people won't ask for the gold. They'll just trade the paper back and forth. That's what the ETFs are. It's not real Bitcoin. Buy real Bitcoin and go to cold storage. These are very small devices that you can use. You can carry around every Bitcoin. You can carry $1 trillion in a little device that looks like a flash drive. And remember, there's an old saying, if it's not your keys, it's not your coin. So if you're holding Bitcoin on an exchange, get it off and get it into cold storage. Don't buy the ETFs. I don't think they're real Bitcoin. And what I do personally, I use what's called multi-sig storage. So not only do I have 2 devices with my own key phrase where I can access my Bitcoin at any time, I also use a company called Unchained Capital, who's one of our partners. And what they do is they create a storage vault. So you could break into my home, steal my cold wallet, have my passwords written right next to it, and you're still going to have to get permission from me to get my Bitcoin. So I would highly advise at least, going through, putting our code in. You're going to get a discount on the services, but they'll talk to you for free and explain that to you. Vaulting is very important. Bitcoin will be the most hacked product in the world over the coming year, without question. So protect it as best you can. Now, common FUD in the cryptos, the Bitcoin crypto world means creating fear, uncertainty, and doubt. So I'm going to address some of these because I think they're just fun and I don't ever hide from them. I've spent years digging into this. The one thing I always get is the NSA and the CIA created it. I answer it very simply. Maybe. I don't know. They created the internet we're talking on now, the microphone I'm using, and the camera that we're using right now. So they do make things on an invention basis. But the reason I think if they did, it might have been people just trying to, liberate people on their money. But I get that question all the time. The end result is it actually doesn't matter if the devil himself created Bitcoin because he has no control over it anymore. It is so decentralized and so high powered in computing power that is literally impossible for anyone to rig the system. And that's not a careless statement. It is literally impossible. And then people say, well, what about the 51% attack? It's true. If someone did gain control of 51% of Bitcoin, they could change all the rules, print more Bitcoin, and do what they want. Number one, that would require consensus, which is never going to happen. But the only other way that could be done is through a nation state attack, which means that a nation state or a collaboration of nation states would need the equivalent of energy to produce 641 exahash of power per second. That means that you would literally need to drain all of your oil and gas reserves, put together all your nuclear power, not sell it to anyone. No one could move. You need all that power times 3 to basically break into the Bitcoin system and change something for a matter of 10 to 60 minutes before all the decentralized node holders kicked you out. I mean, it's really actually almost impossible to hack the system. And then I get it's not backed by anything. I get that all the time. It's not backed by anything. Well, neither is the money you use today. It is backed by sound monetary policy, scarcity, demand, and some people say energy because it takes about $30,000 in energy to produce a $60,000 Bitcoin. That's the prices on our mind. Some people have $50,000, $60,000 fees or cost. So it's not backed by anything except for scarcity, sound monetary policy, the most secure system in the world, and an immutable public open sourced ledger, which is more valuable than gold. So I get that a lot. It's too slow and expensive. This is really not a problem in the world. I hear this is what every crypto company who says they have a better Bitcoin because they have a CEO and investors. Most of them are pump and dumps. That's just a simple fact. I'll be happy to argue with anyone about that and show them exactly how they work. Well, I'll do that. So if you don't mine it, it's not worth anything. Crypto, if you see something that has a pre-mine, it is an altcoin. It is garbage. A pre-mine is a crafty way of saying we just printed it, but we're going to call it mining so it sounds valuable. They pre-mine, they give it to the investors, the shareholders, the CEO, the employees, and then they hire marketing people to create demand for this coin, and then they sell it into the market. They profit, you lose, end of story. That's the most common thread in crypto. But they all say that Bitcoin is too slow and expensive, which is actually not untrue. So on layer 1, pure Bitcoin, it is pretty slow. It could take up to 10 minutes to process a transaction, and it could be quite expensive. However, Bitcoin, in my opinion, has gone past the peer-to-peer network into a store of capital and used for large transactions. I will buy my next house in cash using Bitcoin. That will cost me a few dollars, and if it takes 10 minutes, I'm okay with that because the money is sound. Speed and cost is what got us into this terrible situation we're in now. When digital money was created in 1979, called the uncredit card, when credit cards launched, that was digital money. It's fast and it's cheap. So I don't mind slow and expensive if I don't get debased every minute that I'm alive. I think most Bitcoiners agree with that. It's actually not a bug of the system. It's a feature. I actually want it to be slow so that all the transactions are recorded perfectly. And I don't mind if it's expensive because, as I said, I can buy my house for 21 Bitcoin instead of 43 Bitcoin. If it costs me $6 to transact, I'm okay with that. Poor user experience, I can't deny that. A great company called Lightning right now, great developers, brilliant people. They are creating a layer 2 project, which makes transactions much faster and much cheaper. So layer 1 is expensive. Layer 2 is what you'll use kind of like a credit card with your phone. And then you commonly hear that Bitcoin has no utility, but my altcoin has the greatest utility. Fantastic. That might have actually been a lot of the other crypto projects are faster and cheaper, but the native currency and their security don't even compare. Proof of work is what we use, creates security. Proof of stake is very vulnerable to attacks. So the claim of no utility for money is a ridiculous claim because it is money. I can send it to you within a few seconds, a few minutes. I can pay a little money to do it, but I can ensure that I'm sending you sound money anytime, any place in the world. So that's what I've got for Bitcoin. That's kind of condensing down years of research and multiple books and conversations and conferences and private meetings and conversations with people. If you'd like to get in touch with us, we're at sovereigncapital.com. Just fill out a form. We'll get back to you. We focus in on private mining deals. I actually don't believe in the public mining sector. I think it's very anti-Bitcoin. But we focus on private mining deals that you'll use fiat currency to invest in, and you'll be paid in Bitcoin. And it is designed to create tax write-offs. So our project right now, we're actually working with a group in Kentucky that has 111 oil wells, and we're taking their byproducts and creating an off-grid mining system right now that'll provide about a 60% write-off against passive income, along with producing Bitcoin in the long term for you. It gets paid out every month. We can also help you out with vault building with Unchained Capital. So if you're just new to Bitcoin and I'm not a do-it-yourself guy. I use Unchained Capital for absolutely everything. They're fantastic. We can help you set you up with them to help you build a vault to protect the Bitcoin that you may buy in the future. And if you want to stay in touch with me and follow along with what's happening in money, politics, and religion around the world, I'm at the Rice Report on YouTube, Rumble, TikTok, and I think Twitter is coming up next week. So that is kind of what I've got for you here today, guys. I am a converted gold bug to Bitcoin. And to be honest with you, it's been the greatest decision of my life because I can literally pack up and leave anywhere in the world with all of my money in a hard drive and show up somewhere else and buy whatever I like. And I think that type of freedom is something we should all experience.
It's so interesting that you're speaking just before our gold speaker.
I love gold. I have gold. I didn't sell my gold. About 30% of my portfolio of liquid portfolio is gold, silver, platinum, and palladium. That is money I can touch and feel. I love gold. I am not a maxi only person. I still have gold. I still have a vault. I have plenty of guns to protect my vault also. I just see that right now, I do think, and I talk about it all the time, I think gold will hit 3,000 by the end of the year. I really do. And I see gold going to 5,000 or 6,000 in the next couple of years based on geopolitical events. I own that because gold, I won't lose money with gold. Like I have to have gold. That's where I store my wealth. I'm not going to lose money, but I also don't want to sit all in gold. That's how I came to Bitcoin. I have to have some digital exposure. That's where I was in 2020, 2021. I have to have exposure to the digital world. And Bitcoin provides massive upside, but it's also very volatile. So Bitcoin, the theory of Bitcoin going to zero, I canceled that out, Sarah. So I already have a market order for all 21 million Bitcoin at 1 penny. So if it did fall down there, Eric Rice would own 21 million Bitcoin for $210,000. But everything is a blend. So you need real estate. I tell people all the time, my 6 picks as a macro investor: gold, silver, raw land. I think raw land is very valuable and low taxes. Oil and gas, private oil and gas investments with tax deferment, Bitcoin, and then the 6th one I've added is the VIX, the VIX. The VIX is the counter to the stock market. So the only money I have in the stock market is actually in the commodities market, is the VIX. So when the market crashes, the VIX goes up, and it's pretty simple volatility index. But I'm not the guy who says, put all your money in Bitcoin. I'm not there yet. So for me, I just look at it as my digital future and exposure to the upside with the same properties of gold, just a little more advanced in the digital world. Love gold. Listen to him. I'm going to listen to him. I love gold, and I probably will invest.
All right. Well, thank you so much, Eric. There were a bunch of questions. Will you be back for the Q&A session and we can answer them then?
Absolutely. Yeah,
Okay.
I'll be here.
Perfect. All right. Thank you, Eric.
You got it. We'll see you later.
All right. Sounds good. Next up, we have Kevin. Kevin, please come on camera. Cynthia, stand by with his 2 charts when he has to be shown them. Kevin, thanks for being here. Welcome, welcome. Good to see you again. How have you been?
Yeah, great. Thanks for having me, Sarah. Yeah. Come right after Eric. This is great.
Yeah, coming right after Eric. Yeah, there are 2 things that I thought were interesting that I'd like to begin with. So audience, we're going to do a bit of a fireside chat versus a solo presentation with Lear Capital. Kevin's from Lear Capital. So Eric said there may be a point in time where currency is backed by Bitcoin instead of gold. I hope I'm paraphrasing correctly one of the points I heard him make. I don't know if you heard him say that. So I'd love, since usually, right now people are like, oh, currency backed by gold, currency backed by Bitcoin. What do you think about that? Is it in our future?
Yeah. it probably is in our future. It's just at the end of our future. Like, I don't see the central banks selling off their gold to just go to Bitcoin. I think I agree with him that they could use it as a basket. So you have BRICS and these other countries that are talking about trying to put together some sort of currency to compete with the US dollar, and they're going to back a little bit of it with gold. And then you hear other countries say, maybe we'll back it with a basket of something. And I think that basket of something could include something like Bitcoin, but you have record amounts of central bank purchasing of gold at this particular time. And I think them selling that and moving over to just Bitcoin is probably fairly far off into the future. But the basket idea, I think, is probably more likely.
Very interesting. Very interesting. And then, Eric also said he recommends you buy Bitcoin, not EFTs associated with it. And I'll do a more proper intro to you and your company in a second. But when you're talking about, buying metals, gold and silver, or EFTs, what do you recommend in your space?
Well, I definitely agree with him on the exchange traded funds, right? It's you have a lot of third party risk, right? You have a horrible recession or something bad go awry with a depository going bankrupt, which a couple have recently.
Mhm.
Then how do you get your money out of that, right? Um, but there's advantages and disadvantages to both. So an exchange traded fund, the way I look at it is, look, if you just want to get on and buy and sell in short periods of time and you need that kind of liquidity, then go buy an exchange traded fund, because you shouldn't be buying physical gold if you want to buy and sell it every other day. It's just, that's not physical gold should trade.
Mhm.
But then I ask people, okay, if you're going to if you want to purchase some gold and you were thinking about an exchange traded fund, then think of it this way. You come to me and you say, I want to own some gold. And I said, great, send me your $10,000. And here's what I'm going to do with it. I'm going to take your $10,000. I'm going to buy $9,000 worth of gold. I'm going to send that gold off to HSBC Bank in England, where it's going to be held for you. The other 10% is going to be held in paper gold. So it's really not gold at all. It's just a hedge against the gold price. So they have some liquidity when people buy and sell. And it's all going to be over there for you if you need it.
Hmm.
I think a lot of people who want to own physical gold would say, no, I don't want my gold over in England. I don't want it at HSBC Bank for the third party risk. I want 100% held in gold. And if that's what you want, you need physical gold. If you want liquidity, go with an exchange traded fund. When I say liquidity, we can get you out of the market in a couple of days. But if you're buying and selling on a daily basis, or you're thinking about buying and selling in a month, then you probably shouldn't buy physical gold. There's obviously some risk with storing and insurance and shipping and delivery and things like that if you're
Yeah.
doing it on a consistent basis.
Understood. Good clarification. Really, really love the parallels and theories there.
Yeah.
Yeah. All right. So, audience, thank you for staying on. Those of you who are still here, diehards, loving to learn. So, we've talked about real estate. We've talked about hands-on real estate, hands-off funds. We talked about crypto. And now we're going to talk about metals. So, Lear Capital, it's not just gold, it's also silver. Kevin, what's the breadth of what you do at Lear Capital, so the audience knows?
Yeah, so we anything you can think of with gold, silver, platinum, palladium in physical metal. So if you wanted a 100-year-old numismatic collector type coin, we
Mhm.
can do that. It's a smaller part of our business, about 20% of our business, but we could do that. All the way to gold American Eagles, kilo gold bars, silver American Eagles, 1,000-ounce silver bars. We work with IRAs, so people's IRAs in physical gold, or home delivery, or having it stored for you in the physical form. So that's what Lear Capital does. We've been around since 1997. We've done a little over 3.5 billion in business so far.
Awesome. Awesome. So we've got an expert here for you, audience.
Yeah.
All right, so let's start by, everyone who spoke today kind of started with who's this for, who's this not for. So who do you think should consider investing in silver and gold?
Well, it's a diversification tool for everyone. So it's not good or bad for for anyone. It's how much of a portfolio, how much of your portfolio, or what diversification percentage should you have in precious metals. I agree with Eric. It's not all in on gold or silver. It's a diversification tool so that you have something that's offsetting maybe the fluctuation in the stock market when you had a recession in 2008. Gold and silver skyrocketed. If you look at the gold market since the year 2000, gold has produced returns. I think there's a chart, actually, if somebody wants to bring that up. $100,000 investment in gold starting in January of 2000 is worth 832,000.
Oh, Cynthia, you want to bring up that chart, please? Yeah. Okay, go ahead, Kevin.
And that same $100,000 in the stock market is worth about 325,000. So you would look at the chart and say, well, geez, I wanted all my money in the gold market. And that's not what this chart is here to represent. The chart's here to represent more of a diversification. So if you would have taken $100,000 and placed it in the stock market, you'd be at 325. If you would have placed 80% in the stock market and 20% in gold, that's $390,000. So you picked up a 30% additional return by diversifying with gold over that period of time. So we're not talking about I picked the best time to own gold or the worst time for stocks and did this chart. We're looking at it over a very long period of time.
Mm-hmm.
And it's going to fluctuate a little bit. The Dow Jones might come up a little bit more and gold might shrink down a little bit. But if you diversify, you should even out your returns and have a better return than having just one investment in your portfolio. So again, it's not who is it best for? It's what percentage of your portfolio should maybe somebody take a look at this. So maybe a younger person, because gold doesn't produce interest or some sort of monthly income, they can have a bigger portion than someone, 65 years old, is getting ready for retirement, and they need that income, but they still want the diversification and the safety of gold.
Yeah, I think that's a really great point and really consistent with everyone else who's been talking today saying, diversification is very important as long as it's things that you understand, and you can make reasonable decisions around. Very interesting.
Yeah. That's why I like the gold market. I'm not smart enough to understand 3,000 stocks, but I can understand gold, silver, platinum, and palladium. Supply and demand. And if you could figure that out, then you should do okay in the market.
Awesome. So the chart you showed just now was from 2000 until 2024. And so we didn't really see what happened to gold along the way over those 24 years. But would you say it's a good time to buy gold? It's a good time to sell gold? When can someone know, an investor know, that it's a good time to buy gold?
Well, I think there's a couple of things you want to take a look at. Two big ones are the U.S. debt. There's another chart that if she wants to bring that chart up, we can take a look at that chart, and you can look at how predictable, as the government's printing money, how predictable the gold price really is. So there's about a 89% correlation between the price of gold and U.S. debt. So there's a calculation you need to do, but the chart kind of explains it better than anything, that as debt goes up, the price of gold goes up. So that's one. And with an 82% probability or a correlation, I would go to Vegas all day long with an 82 or 89% correlation, right? If I had an 89% chance of winning, I would be in Vegas all day long. That's number one. Number two is central bank purchases, because they are the biggest purchaser of gold. And anytime they're in the market and consistently purchasing, then the price of gold's probably going to go much higher. So you ask yourself two things. Are the central banks continuing to purchase? Yes, this is the third year of record high purchases of gold in the market. They've been purchasing about a quarter of all of the mining supply per year. This year, it looks like it's a little bit higher, but near that range. So that's a lot of gold that they've been, taking out of the market. How are they doing it? Most of this is selling U.S. treasuries and replacing it with gold. So you have the U.S. dollar coming back on the market from these foreign countries. devaluing the dollar and increasing the price of gold. That's one big reason. The central banks are not hedge funds. They're not day traders. So they don't buy today and sell tomorrow. Typically, they buy, hold for 10, 15, 20 years at a time, and then may liquidate into the future. So you don't have to worry about the supply coming back on the market in the next year or two. Typically, that's not how that would work. And your second question is, do I believe the U.S. government is going to get debt under control, or do we believe we're going to have $1.5 trillion to $2.5, $3 trillion deficits as far as the eye can see? I'm in the later camp.
Yeah.
I believe we're just going to continue to see more and more and more printing. We are printing $2.7 billion a day currently just to pay the interest on the debt, which should hit around $1 trillion potentially next year. Now, with the decrease in interest rates, maybe it takes it a little bit longer with interest rates coming down. But in the next 10 years, they're expecting $1.5 trillion worth of interest payments, and that's the budget office at the government, which I don't think they've ever got anything right ever in any year that they've ever had their budget. So I would say in the next probably 7 or 8 years, you're going to be at $1.5 trillion in interest. So the debt is going to continue to look like this chart, maybe even look more like a hockey stick and go more straight up. And I think the central banks are nervous about the value of the dollar and are going to continue to sell U.S. Treasuries and move over to the gold.
Okay.
This is a supply and demand market, kind of like what Eric was saying with the supply and demand with Bitcoin. I can only pull so much gold out of the ground. All the new technology in the world has not been able to pull more gold out of the ground than what we saw 10 years ago or even 20 years ago. You got to dig deeper, and technology is not helping, pull more out. So unless that changes, then a lower value dollar, higher debt, the nervousness of central banks withholding our dollar and moving over to gold should all continue, and the price of gold goes higher. So long-winded answer to your question, but I agree with Eric that by the end of the year, I think you're going to see gold somewhere around 3,000, and I wouldn't be surprised in the first quarter of next year to see it right around 3,200. We calculate that number based on the debt because that's the highest correlated financial instrument that we can use. It's just what the heck is debt and where's the price of gold? It should be around 3,200 by the first quarter of next year.
So it's not really correlated with interest rates, since we had a cut today and cuts coming in the future, but maybe indirectly correlated to interest rates because the interest rates affects the debt a little bit.
Yeah, the interest rates are going to affect the debt slightly, but gold is not correlated with interest rates. I hear this all the time where people say higher interest rates are bad for gold. Really? Well, if you go back to 1980, we had 15% interest rates and gold hit an all-time high. It was $50 in 1974 and went to $850 by 1980 when interest rates were going up. It is not correlated to interest rates. It's highly correlated to debt. And if you believe that chart and the government's going to slow down the debt, then you probably don't want to own any gold. But if you believe that around the world they're going to continue to print money, then you should probably own a little bit of gold.
So really you think silver and gold they're poised for a breakout because we're poised for a lot of additional debt coming up.
Yeah, you got a lot of additional debt. And look, the government can't stop printing money. It's mathematically impossible, right? Before I got into gold, I was in international banking. I had to know a lot about different currencies around the world. And the reason I got into the gold market was we had to capitalize a lot of these banks with different currencies. There wasn't a euro. So, if we were in any of those different countries, I had to use their currency. And at the same time, I had to hedge all that currency. So we thought, geez, I wonder if we could capitalize some of these banks with gold and just hedge that currency. And I became so interested in gold when it was around $275, $325 an ounce that I looked at it and said, look, this is what it costs to pull it out of the ground. It should be much higher if you look at it just from a supply demand basis at that point. And looking at debt, I thought that the price of gold should be at least $1,200 to $1,300. I quit my very high-paying international banking job and started in the gold market because of that. So what did I learn that got me over the top? And the best example I can give to you of when people say, well, the government can slow down the printing of money is I'll give this example to them. Sarah, let's say you and I live on an island with some other people. You're the banker. Somehow you got all the money in your
Sounds
bank,
like a nice island.
oddly enough, and we use shells as currency. Okay, and
Okay.
our entire currency is 10 shells on this island. And I come to you and I say, Sarah, I have the absolute best business idea you can imagine. We've got this hot island and it's an ice cream, the first ice cream on the island. And you say, that is fantastic. I'm going to lend you the money, how much you need. And I said, I need all 10 shells. You say, fine, little risky. I'm going to charge you 10% interest on your shells. I say, okay. I go out at the beginning of the year, I spend the money, invest the money, and I get all my equipment. And at the end of the year, I have all 10 shells back. It was an absolute success. I come to you, I give you the 10 shells, and you say, fantastic, looks like a great business, but I'm going to own your business today. Why? Because there isn't an 11th shell to pay the interest. We
Mm.
only had 10 shells on the entire island.
Mm.
You, the banker, and the bankers around the world and in the United States have to print that money
Mm.
out of thin air to make that extra shell so that now there's 11 shells. What happens to the value of the 10 shells that were already out there? They go down by a little bit.
Mhm.
So it's impossible for the government to stop printing money. They need the extra money so everybody can pay interest on their mortgages, they can pay interest on this debt, so on and so forth. So this chart is going to keep going up. It's how fast is the money printing going to take place? If it's about the same pace as the economy is growing, then that's probably about right. But that's not the case because there's so much interest owed on so much debt out there that it's growing faster than the economy. And that's why ultimately you probably should own things like Bitcoin, real estate, and gold because you can't print those assets. They're fixed, and that extra money that's going to come out of this printing will drive the prices up.
I love talking about the correlations. So, one of the reasons that the Fed lowered the interest rate is they said, oh, we think we have inflation under control where we want it. So does inflation affect gold price? Is there a correlation there?
Well, there is because the devaluation of dollars usually means more dollars. So the definition of inflation is too much money chasing too few goods. So that's why we had the inflation in the first place was they printed up all this money and all of this extra money was chasing the same amount of goods that was usually out there, but with more money. So the prices went up. So yes, you have fixed supplies in real estate, in Bitcoin, in gold. And if you print more money, then those assets will continue to rise to and offset uh, the devaluation in the dollar. The issue that scares me the most is that there is more currency outside the United States than inside the United States. Okay. And the reason why is the petrodollar. So years ago in the 70s, the United States and Saudi Arabia agreed we're going to make all oil be purchased with US currencies. Okay. So all the countries had to purchase dollars so that they can then purchase oil. That's changing. So if that dynamic changes and you don't need all of those dollars outside of the United States, and so you're looking at de-dollarization news articles with BRICS, and they're talking about BRICS could potentially take over the U.S. dollar or the U.S. dollar for the world's reserve currency. But if you just get a little bit of that happening and people get nervous about holding the dollars, all of those dollars come back into the United States. It's a flood of dollars coming back to the United States, increases the money supply, and prices go through the roof. So you would get inflation that way as well. That's a huge concern because if you look back in history, there's been 6 world reserve currencies. Each one of them has lasted on average about 100 years. The US dollar is right around 100 years now. And everybody's talking about a new potential currency. Every one of these currencies, world reserve currencies, when they got kicked off the stand as number one and fell down, they had inflation because everybody kind of liquidated their currency. The currency came back to their country. Inflation happened, and then uh, it, you know it worked its way out. But I mean, who remembers that Portugal was a world reserve currency or the Netherlands? right? If you ask 100 people, I bet you 3 people might be able to tell you that, because it doesn't matter anymore. Those currencies just
Yeah.
completely got annihilated and nobody cares about them. So
Yeah.
that's a big concern in the
Mm.
next 10 years on the inflation front, in my opinion.
Yeah, that's very interesting to think of how they all influence each other. And, a really good reason to, when you're looking at your investment portfolio, pick different things that serve different goals for you. So I definitely see how metals would have a place in a portfolio. Definitely. Um, Kevin, what do you think are some of the common misconceptions that people have about gold and silver or metals in general?
Well, I think there's two. Oh, well, I know there's two. One, that it doesn't perform, and then we show them this chart.
And then you see this chart. Yeah, I was
Yeah,
gonna say.
and really, and they try to figure out why that isn't true. But it's pretty easy. Go look at what the stock, or go look what the S&P 500, Dow Jones was at the beginning of
Yeah.
2000. Add some dividends in there and see what it is now, and what was the price of gold and what is it now.
Mhm.
So that's one big misconception. It just doesn't perform, and I think that's really um, with Wall Street, right? Wall Street's not going to sell physical gold. They like the exchange traded funds, but man, you can make up some great stories about some stocks. This thing is making chips and everybody's going to go into AI, and this thing should be valued at, you know, whatever, the capitalization rates that they put on some of these things are bigger than some countries. And that's a great story. Gold doesn't have that kind of story. Hey, it's been around for 5,000 years. You could buy a man's suit in 1920 with it, and you can still buy a man's suit with it today. I mean, that's the story,
Yeah.
right? It's going to help protect you. Are you going to get filthy rich on it? Maybe. Maybe if there's some big disaster, it'll double or triple. I mean, I think silver's completely undervalued right now. It's on sale compared to gold, but for the most part, this is for protection. This is protecting your asset, something you put away. It's going to be there. I think Eric said it. My gold's not going to go to zero. I know it's going to be there for me. Bitcoin may have a better upside potential. Gold's going to have more of the safety type of um, situations that people want in their portfolio. So that's really the difference.
Yeah, it serves a different goal. One of the things I really like to talk about is how people can make an investment. So at Sugo Capital, someone can invest in our apartment syndications using their IRA, their solo 401k, trusts, LLCs, pretty much any type of entity, nonprofits. They can 1031 exchange into our syndications. And so I love reviewing that with people, because they often go, wow, I didn't realize I could do all of this stuff that I want to do inside these different types of entities and accounts. And so I've heard of a gold IRA. And so I want to talk about that and bring it up. Is there, if someone has an IRA or a 401k, can they hold gold in there? Do they need a special type of account? Because like you said, this is great for holding for the long term. It's not a cash flow investment that you would want, to pull liquidity from. So it seems like it would be great for your retirement accounts. How would that work?
Yeah, that's a great question. Probably 50% of our business is in IRA accounts or retirement accounts.
Yeah,
So,
same with ours. Yeah.
um, if you have a 401k at your business that you're currently working at, it's very difficult to pull that out. But if you've got some old 401ks, a self-directed IRA or an IRA,
Mhm.
that's your spouse had and passed away and you have it now, all of those can be transferred over to a gold IRA. So you
Okay.
can take the entire thing, or you can take some portion of it, depending
Mhm.
on, how many IRAs you might have, and
Mhm.
just move it right over. So the paperwork takes about 10 or 15 minutes to fill out. Um, and maybe there's a week and a half to transfer the money. And as soon as the money is transferred, we typically get on the phone, give the client a call, go through the metals options. They pick the option that they would like, and we can make some recommendations, but they get to pick. And then we actually move the physical metal over to a depository that is held um, physically for the people. So pretty
Is it
easy
any
process.
different, like how it's held, the physical space and all of that? Is it different whether you invest in your name or with your retirement account, or same difference no matter what?
No, well, it's the same. We like Delaware Depository. It's probably
Mhm.
one of the most highly secured depositories in the country.
Mhm.
So that's who we use. So if you're looking at home delivery and you didn't want to take physical possession, we would recommend that, or Brinks. Um,
Okay.
and for the IRAs, it's held only at Delaware Depository. I know on your program you have on Equity Trust. They're great. We
Yeah.
love them. I know they do a lot of real estate as well, and for IRAs and things like that. And so that's who we use. They have
Okay.
3 billion in assets or something like
Mhm.
that, and very well respected. So makes it very easy. You can pick up the phone, give us a phone call. We can make transfers, buy and sell over the phone immediately when you use them. And the other reason we use them is that a lot of the custodians make you sell the physical gold if you actually wanted to take possession of it. With
Okay.
Equity Trust, they do the paperwork so that you can actually take physical possession, as opposed to turning it into cash and then getting it and turning it back into gold if
Okay.
you wanted to sell or
Okay.
take physical possession.
So for clarity, it's any self-directed IRA, or you need to have a gold self-directed IRA?
It's it's a You need to have a self-directed IRA with us with equity to be able to purchase that gold. Now, if
Yeah.
you have a self-directed IRA that will take physical gold, we'd be more than happy to work with you because we're just
Okay.
delivering the gold to it. But um, for the most part, um, you need some sort of trust that's going to work with physical gold.
Okay. And that's great to hear because I've seen like there's crypto IRAs and gold IRAs. And so this is actually a question of I don't know the answer to, like, are they just self-directed IRAs? Or are they self-directed IRAs specifically for those asset classes? It's kind of where I was going. Or is it just a self-directed IRA and one of the things it holds is gold?
Yeah, so if you have a equity self-directed IRA, you can hold gold, Bitcoin, real estate,
All in the same.
notes, yeah, all in the same account. Yep.
Yeah. Yeah, they're our preferred partner for IRAs as well, self-directed IRAs and solo 401ks. So I think a lot of people on here probably work with them already. So I wanted to make that clear for them that you don't have to make another account. If you already have an account, you can use that same one.
That's right. Makes it easy.
Makes it easy. All right. If you have gold in your retirement account, is there any particular advantage besides, the obvious growth, or I guess that's the end of the question. Is there any specific advantage to holding it in your IRA?
Yeah. Um, so you hold gold outside of your IRA, the government, for some strange reason, because if you hold gold in an exchange traded fund, there's actually a long-term capital gains tax. If you hold it physically yourself, then you pay your personal tax. So that's an unfortunate. I have no idea how the government came up with that. Most ridiculous thing I've ever heard. But so the
Many
IRA
things
does
to
have,
come in
yeah,
first.
yeah. We could make a huge list and have
Yeah.
days of stupidity on what they come up with. But so yes, the advantage is if you think the gold market's going to run, and then let's say a recession ends and the economy gets going again, the silver's industrial, platinum and palladium's industrial, we typically move people over to those types of metals. When you sell the gold, you're not going to pay the tax, just like you wouldn't with a stock or anything else. But at least if you held a stock over a year, you're going to pay long-term capital gains tax, and not
Okay.
that's not the case on gold and silver. So the tax situation helps out a heck of a lot more in
Yeah.
an IRA than it would outside of an IRA.
Awesome. Thank you for that. Kevin, what's the best way for people to get in contact with you if they want to learn more or if they want to do business with you?
Yeah, great question. They can go to learcapital.com,
Okay.
and when they're filling out the information, if they just want to um, put Sarah, your name, by the way, in the
Sure.
form, then we are going to include a $500 credit into everybody's account. And the way that works is you have to make a purchase to use it, but it will cover all of shipping, insurance, handling,
Oh, that's
anything to
right.
get metals for you up
Mhm.
to 500. It will also cover the cost of the IRA fees. So any storage fees, or if you wanted to start an IRA with equity, there's a $50 fee, and then some storage fees and insurance and things like that with physical precious metals, and we'll cover it for you up to the $500.
Okay, that's beautiful. So Cynthia put the link in the chat just now, and then Cynthia, if you just put a reminder if they put Sarah, I guess if there's like a referral or a promo or something, then you guys get that $500 credit. So that sounds nice. Cover the fees.
Yep,
Yeah, cool. Well, thanks for doing that for everyone who's on here.
you bet.
Yeah. All right. Well, what I'd like to do now is keep you on, Kevin, and invite Lee and Eric back on stage. And then we can open it up for Q&A roundtable style. And so everyone who's in the audience, if you want to use the Q&A, I see that there are a bunch of questions in the chat, maybe more conversation. So what do we talk about today? We talked about real estate. We talked about lots of different types of real estate. We talked about being active in real estate, being passive in real estate, who it's good for, who it's, maybe not the best for. We talked about crypto. We talked about metals. And so what happened to me in 2022 is I took a look at my personal portfolio and I realized that we had about 92% of our net worth in apartment complexes. And what happened in 2022 with apartment complexes was, it was not great. So the debt market really hurt the value of our properties. The taxes almost doubled in some of the markets, and our insurance almost tripled in some of our markets. And I went, oh my gosh, here I was humming along thinking like, I'm such an expert in apartments and I'm building so much net worth in real estate. And then I was like, wow, my portfolio is completely lopsided in one asset that, something happens and my entire net worth is affected. I was not diversified enough. And so I have been on a journey in the last 2 years of really making sure that I balance my portfolio among different assets that have uncorrelated risks that serve different purposes. And so I think it's great, audience, when you're listening to these folks, really go back as homework and take a look at your portfolio, because I didn't realize that was our percent. I just randomly one day, like my husband and I sat down, we did our net worth spreadsheet and I did the percents and I was like, oh dear, we need to make some shifting around. So being a confident investor and learning about alternative assets is very important. And then you need to put it into action. So I encourage everyone on here to go back, do that for yourself. Look at your net worth, look at the different buckets. Are the buckets, do they have the same set of risks for each bucket? Or do they have different risks? And do you need to add some of what you've seen today to your portfolio in order to balance it out, in order to give it some diversification, in order to add some security, in order to add some cash flow, in order to add some net worth building in your IRA? So that would be the homework I'm going to give you. And I'd like to invite, so I'll say, it's not a quick journey, but now we're at to about 80% of our net worth is in apartments. And it's just because it's not liquid. So I can't just decide one day, oh, I'm going to move my money out of apartments. Like I have to wait. But I'm definitely on a journey to rebalance. And so I'd like to ask the other speakers as a starting question, is there you can either share what you like to do, Eric already kind of shared it, but is there something that you suggest kind of high level as far as when you're creating a portfolio? Because lots of family offices and uber wealthy do this, right? They decide. They don't just make investments. They decide, I'm going to put 50% is going to be allocated in this investment. 20% is allocated for this investment. So given what's going on today, because it's really different than what you might have suggested 5 years ago, do you have a specific investment or an ideal portfolio makeup that you'd like to share with the audience? And Lee,
Which one of us are you asking?
It's everyone. I would like everyone to answer.
Okay. Well, I guess I'll start. We typically recommend around 20% in precious metals. So we'd be at the higher end of that number right now based on where the markets are and everything that's going on, especially as they lower interest rates. So as far as the other types of investments, I'm not a financial planner, so the people have to figure that out themselves. But 20% in precious metals.
Now, since you're in the space, Kevin, is that reflective in your personal portfolio, or because it's one of your favorites that you know very well is a little bit higher for you?
But it's much higher for me. I'm at almost 42% in metals, and I have a real estate company, a lending company, so I have money over there as well. So Yeah, much higher. But I get to watch it every day, and I've been doing this for 27 years. So it's probably like Eric and Lee. They're experts at what they do. So it's just much easier for us. We don't get emotional about it. We understand it's going to go up and down, and so I
Right.
can be at a much higher limit. And I know I said this when you asked me the question, but look, everybody's different. Someone 70 years old, that percentage might be 7% or 10% or 5% based on how much income they need. So we kind of sit down with people and find out where they are before we make that recommendation. But that's just kind of the general number that we're putting out at this particular point. And we're at the higher end of that, 20%.
Yeah, love it. Thank you, Kevin. Who's next? Lee, you want to go?
Yeah, I'd be happy to. Although, Sarah, I don't know that I'm the right or best person to ask here.
It's just your
because,
opinion or what you do, whatever you want to share.
yeah, full transparency, I can't tell anybody what's best for them. I agree with Kevin. It's really up to what your needs are for your family. But I can tell you for us, my wife and I, we are predominantly most heavily invested in real estate debt, because that's what we know, that's what we do. But I do have precious metals in our portfolio, both in holdings that we have offsite and on-site. And we do still have some crypto. So I really liked Eric's presentation. He really broke it down and made it easy to understand. Thank you for that, Eric, because when it comes to crypto, I'm clueless about it, and I loved what you had to say. So we have a very small amount of it. I mean, it's not even really worth talking about, but for the most part, it's real estate debt. We have developments that we're working on. We've developed a family home office for ourselves, for our own family wealth. But 96% of it is real estate debt, real estate holdings.
Yeah. Thank you for that.
Yeah, my answer I kind of gave earlier. My diversification is gold, silver, Bitcoin, raw land, private oil and gas deals for taxes. So you have a tax and an axe. So I began my career as a floor trader, and I ended up managing money with Morgan Stanley and Raymond James, and I learned all that stuff. This is not financial advice. I'm just simply telling you what I do with my money. Make the best choice for yourself. But I think that for me, as a macro guy and very intertwined in politics and history and how history repeats itself, I liquidated completely from the stock market in 2022 near the end of the year. I took all of my stock holdings and put them in Bitcoin at 17,000. And I did that because I said, well, I'll go back to the stock market. I don't think I will. I think there's a major correction when you look at the overvaluation of U.S. stocks compared to the world. I think anyone holding and Kevin, by the way, great. I've seen you on like 3 or 4 podcasts, Kevin. You're awesome. I think that if you really look at the world as a whole, I think anyone who creates a set pattern of I'm going to own X% of this, this, and this without paying attention to the world doing it blindly, those people get slaughtered at times where they could prosper. And right now, we're in an era where the slaughter is fairly apparent. Kevin did a great job talking about government spending and debt. That is a huge problem that the average person doesn't equate or understand. I saw somebody in the chat talking about taxes. Your taxes don't go to roads. They go to pay back the debt so that politicians ship your money overseas. That's a reality. So the debt market itself is a very good place to be in good times. And it's also a difficult place to be in difficult times. So I saw where we're at now. And of course, the stock market's doing great, but things aren't good when a central bank lowers a 0.5 point. That's just a very big indicator that things are not good. It's good for debt to borrow, difficult to lend. So I think a fixed portfolio idea is a recipe for disaster. So I stay very fluid. I keep a lot of cash, but I rotate it. Like I said, I trade the VIX. I was telling people to buy the VIX in March. The VIX went from $10 to 65 in like 5 minutes at one point. Cash out, you put it back in. I hold my long-term safety money in gold, heavily in gold. I love silver too. Silver's got a lot of struggle to do to get back into their silver balance, which will happen eventually, I believe, in a fair world. Gold is always going to be a winner. You're never going to go broke with gold, but you're also never going to get rich with gold, like really rich. And I think that upside comes from real estate. That's a great place to be. For me, real estate, I'm in raw land because I want future development when timber prices come down and construction comes down and things start to deflate, because that's the environment you'll be in after hyperinflation. You will deflate. So I want the raw land unencumbered. I'll put my own electric and plumbing in. I've got properties in Texas and North Carolina. Maybe I'll build a home. Maybe I'll build an apartment. I'll call you, Sarah, for that because that's your world of expertise. But when I look at it from my perspective, I want the land because there's low tax and high upside over a 10-year period. I like Bitcoin. Bitcoin is kind of my new cash holdings. I want gold for the long term. That's actually my college savings plan for my kid. I'll cash out gold to pay for college if they go. And then at the same time, I invest in private businesses with cash flow. I mean, that for me is always the secret, but everyone forgets that in their portfolio mix. But when you find, like if I could find the right deal on a dry cleaner after this market crashes, I'll buy dry cleaners all day long because they just
Wow.
print money. So
Yep.
simple things like that. Keep it simple. Keep it simple.
Love it. Thank you for that, you guys. So audience, use the Q&A, ask questions, ask interesting questions. So I saw some questions about what are fees for X, Y, and Z. You can find that on their website or you can contact them afterwards. If you have more questions around macroeconomics, around what's happening with these different assets right now, that would be very interesting. So there's a question around RMD. So I think it's really important, and that's a good question because a lot of people forget about it. So you can invest in, everything we've talked about today with your retirement accounts, but then, at a certain point, you have to take distribution. So you do want to look at the timing. How far are you away from RMDs, or are you currently doing them? So how much do you need to reserve and make sure it's in your retirement account before you make an investment? We definitely have had some people who are in apartment complexes and they go, I need some money to do RMDs, and we can't give them their money back to make a distribution. So they have to figure it out. Otherwise it becomes, it's not dissolved, but it's not a good place. So really good question, John. And it's more to say, how do you handle it is you make sure you know when they're happening, how much you need to pay out. And if you have it in gold, which is one of the questions, maybe you need to sell some of your gold in order to make a payment. So just really plan for it is what I would say. Same with tax situations as well. All right, let's see. Any other questions? I think a lot of the questions that were in chat, we answered along the way. All right, here's another question for Eric. What is the risk detriment by not taking action in the Bitcoin crypto space if it's something that will be dominating the future? Oh, Eric, you're on mute.
I could hear myself perfectly.
It was amazing. The knowledge bomb.
It was great. You guys should have heard it. It was really good. Now, Kevin did a great job describing. Maybe I misspoke or was misunderstood. I don't think that Bitcoin will replace gold for anything in backing. I think it'll be added to it. I think it's a very good augmentation for backing things. But the long-term risk of not being in crypto is, I think Michael Jordan said it best. You make zero of the shots you never took. All right, you don't make any shot you don't take. I began in crypto with altcoins. There's another name for them, but I try to keep everything clean. Those are literally the riskiest investments you'll find. I think Bitcoin still has a tremendous amount of risk, but you also have to remember velocity. The up and down of something creates adoption. So over time, it'll level out. I think the risk of not being in crypto, I think we're living through a period where we're going to see a very large transfer of wealth. I did a show on this the other day where you could look at crisis and be afraid, or you could look at crisis and be prepared. And in times of crisis, those are when the largest transfers of wealth ever occur. And when you look at the billionaires, I have a lot of inside contacts places. I know for a fact at the exchanges that billionaires from around the world are making over-the-counter transactions or white glove transactions in Bitcoin, nothing else. Some Ethereum, but if they're stocking up on that as a future store of capital or a way to make payments overseas or around the world in less than 10 minutes for cheap cost, I think everyone. I'm not a maximalist. I think those guys actually kind of drive me crazy because it's terrible financial advice to have all of your eggs in one basket. I think all of your liquid eggs are a good thing, but if you're not exposed to a digital, digital currency is going to be real. They're already trying to do it with central bank digital currencies. So that really tells you where the market is. It's very burdensome to print money, transfer money, transport gold. Everything has a role in the world, a place in the world. Everyone has a slot on the team. But I think the first round draft choice is digital currency, and it began in 1979. So not having exposure, I always tell people, like, if you don't understand Bitcoin, I started buying Bitcoin at $25 a week. That was it. Now I'm shoving money in because I'd spent 3 or 4 years digging into what the heck is this thing I'm putting money into.
Mhm.
And when you start to realize it and grasp it, you really can't look back. And I advise everyone to do that. Another, I saw in the chat, the two books I recommended are Thank God for Bitcoin. It's a biblical approach to the history of money. And the other one is The Bitcoin Standard. Very good books to read. But yeah, I think everyone should have, if you don't understand it, you're a little afraid, just 1% allocation into anything. I look at everything like a private deal or Bitcoin when I got into Bitcoin is what is my risk allocation? How much of my money am I willing to have go to zero for a 10x or 15x return? And for me, I'm a trader by nature, so a lot of my money is risk to begin with. But I looked at it and said, this is something that deserves 1 or 2% of my allocation. And now between gold, silver, and Bitcoin, it's pretty much all of my liquid stuff beyond my home, some raw land and oil and gas investments. That's really all I have. Trade cash with the VIX, and cash. If you do it right, the VIX is kind of a money printer in tough times.
Thank you for that. All right, I'm going to move to another question. It's a bit more tactical, practical, but also very important for investors. So there's an investor asking about internal rate of return. So I believe this was probably written when I was talking about cash on cash, preferred return, ROI, AAR, internal rate of return. So that is often a measurement that people use to compare a whole bunch of different types of assets against each other. And I don't think it's a very good measure of real estate. And Kevin, I'd like to hear your opinion on if it's a good measure of gold, Lee, for what you guys do. But I think it's a good measure for stocks, IRR, but I don't think it's a good measure for other things. Is anything that's compounding. So real estate, it does appreciate, but it's not compounding. So it's a little bit different. And so often if you look at a real estate syndication, if it says 20% annualized return, it means the actual cash money you're going to get from it is around, an average of 20% of your investment per year. However, the IRR might be like 14, 15%. And so you might think, oh, I'm getting 14 or 15% per year, but it takes into account compounding where it's not really compounding. So often our investments will show an IRR, but it's really contrived just because people want to compare it to other investments. But I don't think it's a good representation because it doesn't represent the cash that you get from investments. So if you have an investment you're looking at and it's providing you money, is providing you income, I wouldn't look at the IRR. I would look at the cash on cash. I would look at preferred return or the annualized return. But you can always ask, what is the IRR of one of our projects? And we'll tell you, just know that it's kind of a weird measurement of it. But yeah, Lee, do you guys use the IRR when you're talking about your funds for your investors?
We don't use IRR as a calculation for us just because we are debt and it's all cash flow.
Yeah.
So for us, it's all cash on cash return, and we don't lever our funds. So the money we have in the funds is the money that we originate. Where we do have some upside beyond just the interest rate is where we're selling the paper. So in our private equity funds, we have a accredited investor fund that's a 9% pref, and then we split the surplus. Well, the surplus is achieved through the yield spread. So if we originate a loan for, let's say, 12%, I'm going to sell that loan to a third-party investor at 9%. That 3% is held by the fund, and we continue to earn that 3% over the 12 or 24-month life of that loan. But we recapitalize the fund because when we sell the note, we get 100% of the loan back in cash, and then we redeploy it. So while we may be sitting on a small amount of money in the fund, $30, $40 million, it's actually servicing $180 million worth of mortgage paper where it's getting a coupon on that. So we've never calculated into an IRR per se. It's all cash on cash, and it's preferred, as you said, Sarah. It's a preferred of 9, and then we split the surplus. And we've been doing this for over 12 years, and we've been paying out double-digit returns to our investors the whole time. So it's a great investment. And I will say this though, it puts us, when we compare against like a syndication offering where you have IRR and you have that upside sale at the end of 5 years and you have the appreciation, it's really hard for us to compete on paper with those numbers because the syndications are so much more sexy, to use that term.
Unless you're looking for cash flow, then you're
yeah, if everything goes according to plan,
yeah.
2022 through some hurdles in plans, even in our own syndications. But I think with time, they're going to level out with rates coming down, the ability to refinance, recapitalize those investments. I think there's great upside. But for us, we're kind of boring. And no offense, Kevin, but gold and silver, it's kind of boring. It's consistent. It just does its thing. That's kind of what we do. It's kind of boring. It's debt. It's secured. It pays out every month. It's not going to give you the 15x multiples that Eric's talking about. But for me, I've always been pretty consistent. I like to know what I'm getting at the end of the month without the volatility or the upside or the downside.
Boring pays the bills, man. Always has.
That's right.
Always has, always will.
Kevin, what about, I'd love to hear from you as well. Like, do you ever use IRR when you're talking about metal returns?
Yeah, IRR is really irrelevant for metals. I mean, IRR is really, to me, and I have a debt fund, not quite as big as Lee's. It's very small, $70-80 million, and we just lend for a 2-year, 3-year period. But IRR is really when you're building a building or something like that, and you have uneven cash flows, and when's the cash going in, and you need to figure that whole thing out. And it's all a big, gigantic guess anyway, because who knows when the building's going to sell exactly, and is it going to be on time, and so on and so forth. So I agree with you 100%. IRR is really tough, a really tough one. Well, I think what you said in the beginning is more relevant. If I was buying a pizza truck or something like that, then I can figure out maybe an IRR. Hey, look, I'm going to put some money down today, and then I'm going to get the pizza truck, and we're going to start making money. And pretty soon, I have a return. Then that's when you're going to probably use it. Do I buy the pizza truck or do I buy the sandwich truck? Right? At least you can compare returns from the IRR that way.
Yeah. Thank you.
The terminologies are interesting like that because IRR is kind of like the fax machine, and we now have the cell phone, which is cash on cash. As an investor, cash on cash is all that matters. IRR, like Kevin was saying, that's an internal operation vehicle. It's something you get an IRR if you own a corporation that transacts, that makes products. So as an investor, everything is cash on cash. Have I made more than I put out? I mean, that's the simplest way to track it.
Yeah. It's a heck of a lot easier to calculate too, cash on cash. IRR is a little difficult.
Yeah. I put in 100.
Well, there wouldn't be any
MBAs.
60.
Yeah.
Beautiful. All right. Here's a question. Someone's asking about IRAs and equity trust. Kelly, I'll send you a link since equity trust is not on here, so you can find out answers. But yeah, Kevin and I both work with them. Our investors are very happy with working with them. So anyone else who's looking to create a self-directed retirement account, whether an IRA or a solo 401k, in order to invest in what we've been talking about today, it's just a rollover. It's not a taxable event for you to put money into these accounts. And so we'd be happy to send you a link to be able to do that with our partner. All right. We have Steve. He said, I'm currently, and this will be the last question we take. We're at our end of our time together. They're saying, I'm currently 100% in money market. How do you recommend I rebalance, and in what projected investments and percentages to each? How do I go about investing in this case, VIX, but how about the other things as well? I've studied some and not sure what platform to trade on. I know this is specifically for Eric. I would like to say that anyone who is looking to rebalance based on what they heard today, that is awesome. And it doesn't mean pull all your money out of what you're investing in and put it in with one of us. It more means I'm happy that it created the thoughts in your mind of like, maybe I need to shift some things. And so how do you go about it? I would say first, learn some more. Like learn more if you want to go into a syndication or gold or VIX or whatever it is, learn some more and then learn how to do it and then go do it and start small as you do it. Don't, go gung-ho and put a large percent just because, oh, wow, the returns I saw are way better than what I'm getting over here in money market. So I'm going to take everything and move it over. Go slow. You'll have lots of mistakes in the beginning, and don't worry about it. That's why you need to keep it small in the beginning, and then learn what works for you, realize your successes, and then increase it over time. But I'd love to hear everyone else's answer to that question as well.
Sure,
Yeah,
sure. So, oh,
yeah,
go ahead,
go ahead.
Kevin.
No, I was just going to say, you know, we're not financial planners, so we don't have enough information to even come close to answering, the guy's question, unfortunately. So we'd all have to sit down and ask him a bunch of
Yeah.
questions to try to figure out where he is and allocations and all that kind of stuff. And we're not financial planners. We only specialize in gold, so we couldn't even do that anyway. But he should diversify. I mean, your money in a money market is probably not where you want to be, especially with interest rates coming down. Eric will have a better answer than I will. He was a planner, so he knows more.
I did. I guess I've learned more since then. So when it comes to, first of all, money markets are just lost a half a point. So you have to understand that right now your yield on a money market yesterday just lost a half a percentage point. Money markets, there's almost $7 trillion in money market accounts right now, 7 trillion, $91 trillion in available cash liquidity around around the world. And if you really think about why that is, right? So we have an supposed all-time high in a stock market. We have a struggling economy that just had to lower interest rates. And yet there's $7 trillion in money market accounts. By the way, Warren Buffett has liquidated a few $billion from Bank of America, which is a really big withdrawal for him. He's going into a money market. And the reason is that that's dry powder. So good for you. You've avoided some volatility and some problems there. Like dry powder is important. Money, I guess the best mentor I had, he said, money is a war. You've got to fire your ammunition efficiently. You've got to take down the enemy. You've got to conquer as much land as you can. It was very good advice. A little harsh. I'm a Christian, so it's a little harsh for me. But you have this dry powder and you have time. So I won't make a recommendation because I don't know your personal scenario, but I can tell you what the dry powder around the world is being used for. Knowing that volatility is heavily on the way, like that is a very apparent thing. Volatility is ups and downs. Knowing that there are going to be dips in every market, you have $7 trillion in dry powder waiting to buy dips. And they're not looking to buy and hold. They're not looking to, and these are the big guys around the world. They're not looking to say, you know what, I can't wait for NVIDIA to drop 10%. It's by the way, I'd stay away from NVIDIA, antitrust laws, things like that being violated, big problems. But what they're doing this for is they can actually keep the market afloat to cash out. So 7 trillion in money market right now is ready to be deployed. That'll be deployed for short-term investments, which is why I suggest researching, understanding, and really getting familiar with the VIX. It is going to be a tool you can use in the coming year that'll allow you to weather the storms in the market. But since you have that availability, you have cash, it's earning yield, you're not losing any money. You've got plenty of time to listen to podcasts, to read books, to talk to experts, to really understand what the future will be, because everyone has a different opinion. And to be honest with you, everyone's opinion, there's some part of, like, every lie has truth. Every opinion has fact. And if you can learn to extract the facts and put them together on your own and say, this is where I think the market is going, then you start deploying that ammunition in a very steady, focused, and structured manner, and watch the results, kind of come through. But I would say personally, and this is gonna trigger maybe somebody, I would say if you have money in a money market account, take 5% and buy some gold. Take 5% and buy some Bitcoin. I mean, those two things are very logical to me. They're cash alternatives. Bitcoin's extremely liquid. Gold is fairly liquid, especially the way Kevin stores it. I have stored gold. I have gold in my home. Get things like that because the price of gold actually doesn't go up. The value of the dollar goes down. So like he was saying, you can buy a suit 100 years ago for an ounce of gold, and you can still buy a very nice suit today, actually, for an ounce of gold. And Bitcoin's no different. It's just a digital version that has, hyperactivity on the up and down side because it's new. Gold's been around about 5,000 years, and Bitcoin's been around 15. I would take a small percentage and kind of close your eyes and do that, and then learn about it. And it's exactly how I started when I had cash to deploy. $25 a week went into Bitcoin and 4 or 5 altcoins, and I was taking hundreds of dollars a week and thousands of dollars a week sometimes. Everybody who worked where I worked would always come to me with cash and go, hey, are you going to your gold guy? Yeah, I'm going. I'll buy you gold. I don't want cash. Cash right now, I believe, is the largest detriment. Kevin mentioned a very specific, very important thing that everyone should take with you, and that's the repatriation of US dollars. So it's not just stopping using dollars. And by the way, BRICS is 3 years away from having any form of currency. So you have time. There's a lot of people on the internet, it's going to happen tomorrow, I'm going to die. It's 3 years to build a currency. It's going to be another 5 years to validate any sort of precious metal backing. And I've talked to all the largest auditors in the country, and you really can't audit gold backing. You have to assay every ounce. It's very expensive, very burdensome. So you have some time to make a decision. But what I can tell you is between now and that 3-year period, that is not a good story for cash. In fact, cash is worth 3 cents on the dollar since 1913. 3 cents. So it has been inflated into nothing. And we are printing, Kevin's right, about 2.7 billion a day. They printed 82 billion in the last 2 days. And more importantly, that's going to continue. There is no signal in the world that says, I mean, think about it. If you were an elected official and someone gave you a limitless credit card that somebody else paid back, you would spend money like you were going out of style anyway. It's what you would do. So if that's the scenario, cash in a money market account feels comfortable, 4.5, 2.5, 4.2, 4.7% money market. You have to realize that your dollars are being debased by 1 to 2% per month. That's 10%. You're losing 5% by being in cash, even though it feels comfortable getting 5% return. I love my little money market. I love getting my deposit at the end of the month, but I look at that versus what I would have made other places, and I didn't need the money anyway. I wasn't going to use it for bills. Your cash is being debased faster than you can possibly imagine. It's so bad right now, and it's going to get worse. So put a little bit into something else for a while. Watch these guys. They're all experts and really good. Like Lee's been fantastic. Kevin's amazing. Listen to their podcasts. Listen to their views on the market. Listen to people you disagree with. That is so important. You may not like a sector or a story, but listen to them. There's always a truth and a lie, and you'll be able to find out what makes sense for you moving forward, but get some of that money out of your money market account and get it into something that'll produce a better return. Just a small amount.
Lee, did you want to take a stab at that?
Yeah, such great information from both Kevin and Eric. Thank you for that. For me, my wife and I store the bulk of our cash in money markets, but it's not an investment strategy. It's not a saving strategy. It's merely a storehouse while we're seeking the next opportunity. So when we're lending, money comes out of money market to loan pays off, back to money market. We identify real estate investment. Money goes out of money market into real estate investment. That investment is sold or recapitalized through refinancing. Cash goes back into money market. Personally, I don't like putting anything, I refer to as cul-de-sacking your cash, where you put it into something that you can't get out very quickly. So we try to be in very fluid investments that we can either recapitalize through other debt, other financing, but we want our cash to be available and ready to go into anything we find that's interesting, where we can get great returns, safe returns, but it's also highly liquid, so we can get it back out. But for us, money market, I think right now we're earning 4.2 on our sweeping balances. And that's a nice place to just keep it. But I certainly wouldn't be storing it there as an investment strategy or as a long-term retirement plan. I completely agree with everything Eric and Kevin have both said here.
Well, awesome. Thank you guys. That and everything else that you shared today was excellent, top notch. I'm really honored that you all came to the Confident Investor to speak with our audience. And audience, thank you for the great questions and being really engaging. And I encourage you to reach out and continue to follow and learn and invest with the folks that you've seen here today who piqued your interest or have something that aligns with what you'd like to do in the future. Speakers, I would like to do a screenshot that Cynthia can put up. So if everyone would just wave and smile, we'll do a 1, 2, 3. All right. Cool. Audience, replays going out today, along with links of how to contact everyone. So with that, we'll wrap. And thank you so much, speakers. It was an honor. Have a great day.
You too. Thanks for having me.
Thank you.
Thank you.
Great
God bless
job.
you all.
Thank
Appreciate
you.
Have a good one, everybody.